So welcome to yet another amazing session on CA Final Financial Reporting, and I hope our audio is absolutely amazing, right? So today, as we all know, we have completed 50% of the financial instrument. So we have thought that whatever we have studied, we will revise everything in detail, right? So the 50% content of financial instrument will be revised in this particular lecture. I will also upload this lecture on YouTube, right, for everyone, for you guys also, and for everyone at large. So for those who are going to watch in future on YouTube, if you are watching this video without subscribing to the channel, don't do that. Okay, also please do like the video, and if you want these board notes, you can download the same from my Telegram channel. The link is in the description box. Okay, so this message was for the YouTube students. Now, so in this lecture, what I'm going to do is, we have revised approximately 50% of the portion and try to make it very easy for you. So in this particular session, we will revise the concepts which we have covered along with the questions in detail. The revision in detail will go very slowly so that you are able to recall each and every thing. Okay. Also, those who are watching it, I would request you to please keep on repeating what I'm asking you, at least in your mind or in the chat box or anywhere you like, right? So that the revision becomes very effective. This revision is going to be in 100% English. So even my South Indian students, South Indian friends from South India part of the country, if you don't understand Hindi, it is absolutely fine. You will definitely benefit from this lecture because it is going to be in 100% English. So without wasting any time, let's start the revision in 3, 2, 1, and oh yeah. Okay, so let's start. So first of all, we were discussing about financial instruments. Total, how many indices are there in financial instruments? We have 3 indices: Index 32, Index 109, Index 107. Okay, what does 32 talk about? Mainly it gives the definition part of the index. Okay, what does 109 talk about? It gives the accounting part of the index. And what does 107 talk about? It gives the disclosure part of the chapter. So of course this is not very relevant. 32 is relevant for the basic clarity, but the important index out of this 3 is 109, of course, but we will cover all of them. First being index 32. What did we study in index 32? There are total 3 aspects to be focused here. One is the definition point. I'm only going to revise the relevant part in this revision video. Okay, do remember that. Okay, so one is the definition point. Second is the fixed to fixed text wala point, and third is the compound financial instrument. So let's revise first the definition. Now, what is the definition of financial? First definition is of financial instrument. So what is financial instrument? Before studying this, you should know what is financial asset, what is financial liability, and what is equity. So let's start with what is a financial asset. So ideally, it is any asset. First of all, to be a financial asset, it should be an asset which is either cash. That means if you have a cash balance, bank balance, it is a financial asset. Or equity instruments of another entity. That means if you have invested in any company's equity shares, it is a financial asset for you. Example, let's suppose I, Aakash Kandoi, invest in the shares of Reliance company. So that Reliance company equity shares will be for me a financial asset. Second, okay, that was A and B. Then point number C. Total point number C has 3 points: C1, C2, C3. What is C1? Contractual right to receive cash. What is the meaning of this? If under any asset, you have a contractual right to receive cash. Example, debtors. What is the meaning of debtors? I make a sale on credit. So from that party, I have a contractual right to receive cash. Contractual right. That means that party 100% has to pay money to me, right? That is known as contractual right to receive cash. So that will consider to be a financial instrument. Okay, that was C1. What is C2? Contractual right to receive equity instruments of another entity. What is the meaning of this? If you have any asset under which you will not receive cash, but you will receive equity instruments of another entity. Sir, what is such instrument? Example, when you invest in any convertible debenture. So under convertible debenture, for the interest part, you will receive cash. Okay. But for the principal part, they will not give you a cash back. They will give you the equity shares of that company. That means here in this convertible instrument, you have a contractual right to receive equity instruments of another entity. So it will also be a financial asset. Third point is contractual right to receive any other financial asset. Sir, give an example of this. Simple example is when a financial asset is not giving you cash. He is not giving you shares, but is giving you any other financial asset. Example, trade receivable is giving you bills receivable, right? From that particular debtors, you are not going to receive money. You are not going to receive shares. You will receive bills, some bills. So that is contractual right to receive any other financial asset. Okay. And also there is a D point, contract to exchange financial asset or financial liability under potentially favorable conditions. What are these? These are nothing but derivative instruments, just like betting. When you bet, so either there is a probability to win or lose. If you are in a winning position, that means you are in a favorable condition. So such derivative contracts will also be a financial asset for you. Example is there below, we will discuss it, don't worry. So this was the basic definition of financial asset. We also discussed many examples. I will quickly run through all the examples. First, cash balance, it was financial asset. Trade receivables, it was financial asset. Inventory, not a financial asset. Sir, why? See, they have not mentioned whether it can be converted into cash or not. If you sell inventory, you will receive cash. But is there a contractual right to receive cash? The answer is no. No one has promised to give cash against inventory, right? There is no contractual right. Of course, it can be converted into cash, but there is no contractual right. So inventory is not a financial asset. Same applies with PP, not a financial asset. Loans and advances given, whenever you give a loan, you will receive the interest, you will receive the principal, it is a financial asset. Investment in another company, liquid share, financial asset. Investment in bonds. What is the meaning of investment in bonds? Just imagine, when you invest in bonds, you will receive interest, you will receive principal, so it is a financial asset. Acha. Investment in Reliance company, convertible bonds. So if you invest in a convertible bond, will it be a financial asset? The answer is yes, because interest you will receive in cash, principal you will receive equity shares of that particular company. So even the contractual right to receive equity shares is a financial asset now? Yes. Acha, for deep clarity purposes, I have also discussed in the class the definition reference. That is as per the which point it is financial asset. A, B, C1, C2, C3. That you can do. But to be honest, even if you are able to identify this much, it is more than sufficient. Anyways, let's proceed. If you invest in preference shares, so that means any kind of investment, whether in preference shares, whether in bonds, whether in debentures, whether in equity shares, whether in convertible instruments, it is nothing but a financial asset. Okay. What about gold? See, in gold, it is just like inventory. Like, just the logic is same like inventory. Gold can be converted into cash, but there is no contractual right here, so it is not a financial asset. But what if you invest in gold bonds? So when you invest in gold bonds, then it becomes like a normal bond, right? So it is a financial asset in that case. Acha, what if there is a prepaid expense? What is the meaning of prepaid expense? Let's say, for example, you buy my lectures. So lectures excess, when you buy, you will get the excess afterwards. That means you are paying the fees in advance. So for you, that fees paid in advance is a prepaid expense. So whether that prepaid expense will be a financial asset, the answer is no. Why? Because against that prepaid expense, you will not receive, you don't have a contractual right to receive cash. You will receive services or goods. For example, if you make the payment of fees in advance, you will not receive your amount back. You will just receive the either the lectures or you will receive some services from my side, right? So prepaid expense is an asset but not a financial asset. Okay. What if under the prepaid expense I refuse to give the service? For example, you paid the fees to me, I refuse to teach you to you. That means I have now obligation to give cash back to you. That means when under prepaid expense the service has been refused by the other party, that means the cash which you paid is now refundable. In that case, it will become a financial asset. Don't worry, we have already discussed this in detail in class. Okay, do remember. If there is interest receivable, contractual right to receive cash, financial asset. Bills receivable, financial asset. Security deposit given. So what is this? Remember, we discussed in rent agreement. The tenant gives some deposit to the owner, which is refundable at the end of the agreement, right? So such deposit is given by the tenant. For tenant, it is a financial asset. Why? Because he has a contractual right to receive the deposit back at the end of the agreement, right? Okay. Trade receivable, against whom you are going to receive the bills receivable, right? One financial asset promising you another financial asset. So again, this trade receivable will be a financial asset. Okay. What about income tax refund? See, under income tax refund, you have a right to receive cash, but that right is not a contractual right. We discussed it. It is a statutory right. So it is not covered here. Apart from it, if there is any investment in subsidiary, joint venture, associate, it is covered under separate Ind AS, not covered here. Do remember that part. So these were the definition of financial asset along with the examples. I am going very slow so that you are able to recall each and everything. Okay. Let's proceed further. Definition of financial liability. What is under the definition of financial liability? First point. Now it should be liability. It is any liability where you have a contractual obligation to deliver cash. See, because now it is a liability here, you won't have a right to receive cash. You will have an obligation to deliver cash. So whenever you have an obligation to deliver cash, it is a financial liability. Example, creditors, trade payables, loans. Okay. Okay. Or if there is a contractual obligation to deliver any other financial asset. So if you are delivering cash, financial liability. If you are delivering any other financial asset apart from cash, what is financial asset? We discussed above. So if you are delivering any other financial asset, then also it is a financial liability. Okay. Contractual obligation to deliver or exchange under potentially unfavorable condition, as discussed. Let's say, for example, we enter into a betting. So for one party, it will be after some days. For one party, this contract will become favorable. So for him, it will be a financial asset. For the other party, this contract will become unfavorable. For him, it will be a financial liability. Don't worry, we will discuss about this point in detail under the derivative point. Anyways, but just understand whenever you enter into a derivative contract, if the position is favorable, it is financial asset. If the position is unfavorable, it is a financial liability. Anyways, there is point number C also, but that I will study when I will revise the fixed to fixed test. Okay. Anyways, let's proceed. Some examples for this point of financial liability. So if you have any trade payables, it is a financial liability. Loan taken, under loan, whenever you take a loan, you have an obligation to give the interest and principal back. It's financial liability. Outstanding salary, what is the meaning of this? Whenever the company has not paid the salaries to employee, it becomes outstanding salary. Such outstanding salary is also a financial liability. Why? Because if the salary is outstanding, can I say the company will have to pay the salary to the employee some other day? So it is a financial liability. Okay. Advance income. What is the meaning of advance income? Do you remember that example when you are paying the fees in advance for my classes? So for you, if it is a prepaid expense, for the other party, it is advance income. So let's say, for example, you paid the fees of classes in advance. So for me, that advance is advance income. So under advance income, will it be a financial liability? The answer is no. Why? Whenever I receive any income in advance, I will not give you the money back. Of course, I will give you the services or goods in place of that cash. So it is not a financial liability. Acha, what if the contract is cancelled? I received advance income, but I refuse to give the services. In that case, I will have to repay your money back. So it will be a financial liability in that case. Okay. Debentures issued. Whenever you issue a debenture, normal debenture, under normal debenture, whenever you issue it to raise funds, so you have to repay the interest back. You have to repay the principal back. So it will be a financial liability. Okay. Now comes the important part. Issue of own equity shares. Whenever the company is issuing equity shares to raise funds, it is not a liability. It is an equity. So whenever the company has to issue or deliver own equity shares, whenever under a liability or any transaction, I am delivering my own equity share. So for the party who is delivering his own equity share, it is an equity transaction, not a financial liability. Do remember that part. Okay. Similarly, if you issue convertible bonds, convertible debentures you issue. Now you are on the issuer side, not the holder side. For holder, this is a financial asset. I'm talking from the point of view of issuer. The person who is issuing these debentures, let's ignore the interest part. Under convertible debentures, the principal has to be given under equity shares. So if it is a convertible debenture, for against principal, the company will not give cash back. The company will give its own equity shares. So as I said, whenever you are delivering own equity shares, it is not a liability transaction, it is an equity transaction. Just remember that part. Okay. So whenever you are delivering cash or any other financial asset, it is financial liability. Whenever you are delivering your own equity instruments, it is an equity transaction. Do remember. Okay. Similarly, for convertible preference shares, dividend just ignore. Principal, you are delivering own equity shares, it is an equity transaction. Acha. What if there is a normal preference share issue? Normal means redeemable preference shares. See, there are two types of preference shares. One is convertible. That means you will convert the principal into equity. And one is redeemable. Redeemable means you will, whatever you give in cash. Dividend you give in cash. Principal you give in cash. So whenever normal preference shares are issued, it is a financial liability, right? So that means what you studied in your IPCC or maybe your CPT, what you studied is preference or equity. Debenture is liability. That is not the case always. Why? As per Ind AS, you will have to check the substance over form. That means check whether the preference or debenture is convertible or redeemable. If you see closely, if the debenture is convertible, that means principal you will give equity, own equity shares, it is an equity. So that means debenture can also be equity. Acha. If it is a normal preference share issued, redeemable preference share, where you will give cash only, it is a financial liability. That means preference share can also be financial liability, debenture can also be equity. Depends on what? Depends on whether it is convertible or redeemable. Do remember that part. Okay. Then, if you promise to give your trade payable, not giving cash, but giving any other financial asset like bills receivable, so it is a financial liability. That trade payable is a financial liability. Do remember. Income tax payable, it is a statutory obligation, not in the scope of FI. If there is any provision, not in the scope of FI because it is discussed in India 37. Security deposit accepted. See, we discussed that security deposit given was a financial asset. For the giver, it is a financial asset. For the owner who is receiving the deposit on day one and has to refund in the future. So for this owner, it is a financial liability. No? That is what we discuss here. That the person who is accepting the deposit, for him, it is a financial liability. Right? Also, I made you write one point to know for that whenever you are discussing about delivering own equity shares, that is an equity transaction. Do remember that part. right? So guys, are you clear till here? Till here, did you understand everything? This was the basic two definitions. I have consumed, I have gone slow so that you are able to recall this part, because if this is strong, future points will also be, can be discussed easily. Ooh yeah. Okay sir. Chalo, let's continue. Acha. So you understood what is FA, you understood what is FL. Okay. Now I am going to discuss one important concept, that is compound financial instrument. Now what is the meaning of compound financial instrument? It is any instrument which has both components, little FL, little equity. That means in a single instrument you have little FL also, you have little equity also, little love also, little magic also. Okay sir. So that is known as a compound financial instrument, right? So how to know whether any instrument is CFI or not? In short, I will call this CFI. Okay. So how to know whether this is CFI or not? So first of all, we discuss some examples. Let's say debentures can be of two types, either it is redeemable or convertible. First we are discussing about redeemable. Who are we? We are the issuer. For issuer, it might be a financial liability or equity. Okay. So we are the issuer. We issue some debentures which are redeemable. Redeemable means interest also you will give in cash, principal also you will give in cash. So you raise some funds to debentures which are redeemable. Interest payment will happen in cash. So it will be a financial liability. Acha. Principal payment will also happen in cash because it is redeemable. So it is also a financial liability. If both the elements are financial liability, it is not a CFI. Simple. Okay. The second part. What if I say the debenture is compulsory convertible? What is the meaning of compulsory convertible? That means interest will be given in cash. But when you repay the principal, here, because it is compulsory convertible, here the company will not give the cash back to the holders. It will give its own equity shares. So when it is compulsory convertible, now look closely. Still the interest has to be repaid in cash only. So the interest elements becomes FL. But for principal, against principal, the company, the issuer is not giving cash back. It is giving its own equity shares. So as we discussed above, whenever the company is delivering own equity share, it becomes an equity transaction. So little FL, little equity, the instrument becomes CFI, compound financial instrument. Oh yeah. Okay sir. What is this? Oh yeah sir, I don't know. I heard it somewhere and it's stuck in my mind. Okay. Anyways, same discussion applies to preference shares also. So preference shares again can be redeemable, can be convertible, right? So if they are redeemable, in preference shares we pay dividend and we pay principal. Okay. Now for dividend, just remember, dividend can be discretionary also, can be mandatory also. If the dividend is discretionary, that means company will pay the dividend only when they have funds. So in that case, if anything is discretionary, that means there is no obligation, that it is not a financial liability. But if dividend payment is mandatory, it will be a financial liability. What to assume in case of preference shares? When nothing is mentioned in the question, always assume dividend payment is mandatory, right? So you will assume it to be a financial liability. Acha. So if let's assume we have a redeemable preference share where dividend is mandatory, it is a FL. Well, principal, because it is redeemable, you will give in cash. So principal is also a financial liability. If both are financial liability, then the whole instrument is FL. But what if the preference shares are compulsory convertible? Compulsory convertible means dividend being mandatory has to be paid in cash. So it is FL. But principal, under principal, the company will give own equity shares. Why? Because it is compulsory convertible. So little FL, little equity, again it becomes a CFI. Right? Acha. We made one more discussion here. Under debentures, if they are convertible but not compulsory convertible, that means the option for conversion is with someone, either with the holder, either with the issuer. Right? So now let's discuss this part where the convertible part is optional. An option is with some party. Okay. So if the conversion is at the option of the holder, if holder of the instrument has the option of conversion, then what to do? In that case, interest, you can say, let's assume debenture. Okay, let's take one by one. Debenture, convertible, conversion option with the holder. What to do with interest? Whoever has the option, interest has to be paid in cash. So interest will be FL. What about principal? If holder has the option, see, we are whom? We are the issuer, but option is with the holder. Holder means the one who is investing in our company. So we are the issuer, we are the one who is issuing the debentures, but option is with the holder. Then what to do? Remember, I had taught you one line. Just ask yourself whether issuer, whether we are the issuer, whether we at our own will, can we avoid paying cash? Whether the issuer at its own will, can he avoid paying cash? when the holder has the option, if the holder demands cash, issuer will have to pay cash. If the holder demands shares, issuer will have to give shares. But can the issuer at its own will refuse to give cash? The answer is no. That means the principal will be FL for issuer point of view. Why? Because the issuer at its own will cannot decide whether he wants to give cash or avoid paying cash. Right? So whenever the option is with the holder, interest will be FL, principal will also be FL. If both are FL, it is not a CFI as of now. Okay. What if the option of conversion was with the issuer? If issuer has the option of conversion, interest still has to be paid in cash, so it is FL. But if conversion option is with the issuer, then principal is avoidable. It can be avoided. Why? Because if the option is with the issuer at its own will can avoid paying cash. So the principal becomes equity. So little FL, little equity, it is a CFI. Right? Okay, sir. So then I took a oral test for you. Tell me whether different instruments are CFI or not. You already answered me in the class. Don't worry about it. Then one small conceptual thing we studied, that the concept of CFI is only from the point of view of issuer. For holder, there is no concept of CFI. Holder means the investor. For investor, there is no CFI. Because for investor, whatever he receives, whether he receives cash or whether he receives shares of that particular company, for him it is both of them are financial asset only. So the concept of CFI is only applicable from the point of view of issuer. For holder, there is no concept of CFI. Okay, for holder, it is only a financial asset. Don't worry about it. Okay, simple. Then, so we discussed definitions. We discussed compound financial instrument. The next point under Ind AS 32 was fixed to fixed test. Now, what is the meaning of this? A simple test which is conducted to know whether the item is equity or not. For example, let's say I issue compulsory convertible debenture. When I say compulsory convertible debenture, can I say interest I have to give in cash? But for the principal part, because it is compulsory convertible, that means for principal the company will give own equity shares. So principal is equity. But whenever we say the principal is equity, we will call it equity provided it meets one test, and that is known as fixed to fixed test. That means whenever in the above example also we called any item equity, it was subject to the condition that it is meeting the fixed to fixed test. Right? Now, sir, what is this fixed to fixed test? Okay. So just understand, it is very simple. The instrument which you are going to convert, let's say for example, for convertible debentures, I will give equity shares. So the number of debentures that are going to be converted should be fixed on day one. That means on day one only you should tell that I will convert 500 debentures. And against these convertible debentures, how many shares you will issue, that number should also be fixed on day one. That means, for example, let's say against the 500 debentures, I will give 5,000 equity shares. This number of how much convertible debentures will be converted and how much number of shares will be issued, this number for both the elements should be fixed. If these both are fixed, we will meet the fixed to fixed test. And if fixed to fixed test is met, then only it will be an equity element. Sir, what if F to F is not met? If fixed to fixed is not met, then the element will be a financial liability. So let's say, for example, the number of debentures are not fixed, they are variable. But in equity shares to be issued are fixed. Doesn't matter, financial liability. So that means if any of this element is variable, financial liability. If both of them are fixed, then it is equity. In detail, we discussed in class itself. Okay. Acha, what if nothing is mentioned? If nothing is mentioned, you will always assume that fixed to fixed test will be met. Simple. Is this clear to everyone, guys? Perfect. Okay, let's proceed further. Then, that means for any element to be known as equity, two conditions are there. First of all, for that element, company will give own equity shares. And second, that the fixed to fixed test will be met. If both of these are met, then only it will be equity. Right? Acha. Now come towards the definition of financial liability again. Now I will do interlinkage with you. See, under financial liability, now you can read the fourth point. Now you can the C point. What is written in C point? Contract to issue own equity shares in variable numbers. That means whenever you are giving own equity shares and the numbers are variable anywhere. That means, in short, if the fixed to fixed test is not met. See, where it is written in the definition of financial liability. That means if the own equity shares are variable or if fixed to fixed test is not met, then it will not be an equity, it will be a financial liability. That is why it is written in the definition of FL. Okay, sir, done. So this was a definition of equity as well. So with that, we have covered Ind AS 32. Tell me, guys, are you able to understand till here, yes or no? See, this all definitions we have covered. The definition of financial asset, liability, equity, F2F and CFI. Acha, what about the definition of financial instrument, sir? It is a very simple definition. See, if you want to see the definition of financial instrument, now you can understand this definition. It says it is a contract that gives rise to financial asset for one entity. That means any contract under which that contract is a financial asset for one entity, and for the other party it is either a financial liability or a equity. That means if you and me enter into a contract, when will our contract be a financial instrument? When for you it is a financial asset and for me it is a financial liability or equity. Then only this contract will be a financial instrument. Simple. I hope this Ind AS 32 is crystal clear till here. I have covered all the relevant points that are there in Ind AS 32. Of course, there are many other points, also small points, but that are not very critical from exam point of view. From exam point of view, if we are clear till here, that is more than sufficient for Ind AS 32. Clear? Perfect. Okay, I like it. You have heard this line. There was one movie Kabhi Khushi Kabhi Gum. In that, they used to, one actress used to say it. I like it. So even I will say I like it. Okay, anyway, sir. Now let's proceed with the other part of the chapter, that is Ind AS 109, the most important part. The bigger questions, the practical questions are of course asked only from this Ind AS. Now what do we discuss in this Ind AS? We will use the board notes again. See, again I'm telling you, if you want this board notes, they are available on Telegram. You can join from the description is given below. Okay, sir. Chalo, let's discuss the Ind AS 109 part. The first part is classification. First point. Now what is the meaning of classification? See, ideally any financial instrument can be classified into three aspects. One is financial asset, one is financial liability, one is equity. Now, how to account for all these three? So first we discuss for financial asset. What is the meaning of accounting? That means, let's assume we have a PPE. Do you remember for PPE, we used to say initial measurement at cost, subsequent measurement at cost, or revaluation model, company the choice. Similarly for financial asset, how will the accounting will be done, right? So that is known as classification of financial asset. So for financial asset broadly, we have four methods. One is either ACM method, that is amortized cost method. Second is FVT OCI method. In FVT OCI, we have R or NR. What is the full form of this? FVT OCI means fair value through other comprehensive income. R means reclassified to PNL. NR means not reclassified to PNL. The discussion of the difference between R and NR, we already discussed in Ind AS 16. Okay. Then the fourth point is FVTPL. How come fourth? First ACM, second FVT OCI R, third FVT OCI NR, fourth FVTPL. FVTPL means fair value through profit and loss. Now, out of all these methods, which method will we choose? Will the company has the choice? The answer is no. In this case, which method to apply? It is not dependent on the choice of the company. It is dependent on the outcome of certain test which we will conduct. Out of those tests, we have two tests. One is business model test and one is contractual cash flow characteristic test. In short, we call it as CCFC test. Okay. Now, what is the meaning of business model test? Business model test will have three outcomes. Not going to detail, but revising everything for you. It will have three outcomes. One, you will either hold your instruments. Second, your model is either hold or trade. Third, it is trade. What is the meaning of this? Hold means whatever instrument you buy, you hold till maturity. That is your business model. Second is hold or trade. Whatever instrument you buy, you might either hold it or, but if you get a better opportunity, you can think of selling it also. And the third type of business model is trade. Whatever you buy, you always think of selling it in the near future. Okay. So these can be the three business models of the different companies. This is an entity specific test. You will check this thing for entity as a whole. Okay. Now, CCFC test. In short known as contract. In short known as, in big it is a short form is already CCFC. In big it is known as contractual cash flow characteristic test. In short known as CCFC test. Now here there are only two outcomes possible. Either it is met or not met. Right? How do we come to know whether met or not? Simple. If from any financial asset, we are only discussing about financial asset. Okay, do remember that part. If for any financial asset, your motive is to earn only two types of cash flows. One is interest and one is principal. That means your intention is to earn only the promised cash flows. For example, if you invest in debentures, you are promised to get interest over the period, and at the end of maturity, you will get your principal back. So if your intention is to earn only the promised cash flows, then CCFC is met. But if your intention is to earn anything apart from what is promised. Like for example, you are thinking that I am investing in this instrument, but I will sell it in near future, so that I can also earn some capital appreciation or some capital gain loss might arise, right? So if your intention is to earn anything apart from the promised cash flows, then CCFC will not be met, right? This test is instrument specific test. What is the meaning of instrument specific test? See, business model, let's say for example, company has 10 types of investments. So this business model test is done for the company as a whole, right? But CCFC test, if the company has 10 different investments, this CCFC test will be done for individual investment. That is known as instrument specific test, right? Okay. So to understand this point further, we also discuss certain examples, whether these instruments will meet the CCFC or not, right? So out of this, one important case was investment in equity shares. Whenever you invest in equity shares, there are no promised cash flows. Dividend is neither promised. The principal payment is not promised at any maturity, right? So under equity instruments, since you will never meet the CCFC test. Why? Because dividend is not promised, principal not promised, right? If you want to recover anything, you will have to sell it. So here in equity shares, CCFC will never be met. Do remember that part, right? For debentures, it can meet, it cannot meet. You can read the examples, you will understand. Okay, clear? Yes. So now we did two tests. Business model test done, CCFC test done. On the outcome of these two tests, we will come to know which method to use, right? For example, if your business model is hold and CCFC is also met, that means in business model as a whole, you say you are holding the instruments, and CCFC, when you came to instrument specific test, it is also met. That means you are only there to earn the promised cash flow. That means you will not sell the instrument, in short. Then they are recommending to use ACM method, amortized cost method. If the CCFC is not met in this case, use FVTPL. Okay. If the model is hold or trade, but CCFC met, you will use FVT OCI R. If the CCFC is not met, use FVTPL. In the third case, when the business model itself is trading, no need to conduct CCFC. In any of the cases, FVTPL is the only method. How to remember this? I'll give you a small hint. In the first two cases, whenever CCFC is not met, the by default method is FVTPL. Okay, simple. In the third case, always FVTPL. Now it is easy to remember. If the model was hold, CCFC met, ACM. If the model was dicey, hold or trade, but CCFC was met, then FVT OCI R. Okay, now under these two cases where they were recommending directly FVTPL, there is also an alternative option given. Alternatively, the standard says you can choose an irrevocable option to use FVT OCI NR. Why is this option given? This is mainly given for investment in equity shares where the CCFC is never met. So it is little harsh on the company to directly recommend for FVTPL, because if you use this, all the fair value changes will go in profit and loss. So little harsh for the company, because if they have investment in equity shares, CCFC is never met. So instead of directly using FVTPL, the company can choose. This is an irrevocable option to choose FVT OCI NR. Okay, do remember that part. So this was business model and CCFC test. Just a basic idea, if you have, that is more than sufficient. This was for financial asset. Now we come towards financial liability. For financial liability, we only have one method, that is ACM method. Do remember, there are no multiple methods. So if there is only one method, do we need to conduct any test for this, which method to use? The answer is no. If you are running in the race alone, you will only win now. So if for financial liability there is only one method, then no need to conduct any kind of test, right? Of course, in few cases, India says for financial liability you will use FVTPL. Those cases are defined, like derivatives and financial guarantee. Those cases are specifically defined that for these particular cases use FVTPL. That means for financial liability, all cases ACM, but for few cases FVTPL. If anyone will ask you, just say that ACM is the only method, but yes, for few cases which are defined by India, we will use FVTPL. Is this clear to everyone? Oh yeah. Okay, sir, done. Now, if you can see closely, there was one method which was common for financial asset also and for financial liability also, and that method was ACM, amortized cost method. So first we will learn the accounting under amortized cost method. From exam point of view also, this is the most important method, right? So under amortized cost method, what all things do we have to discuss? If you want, I will come towards this chart. Now see this closely. Under ACM method, see, this ACM method is common for FA also, for FL also. Okay, we have total three cases to be discussed. One, where fair value is equal to transaction price. I will teach you what is this. Second, where fair value is not equal to transaction price, That means there is the relationship somewhere involved. Third case is compound financial instrument. In compound financial instrument also we have three cases: without a transaction cost, with a transaction cost, and conversion or early settlement of compound financial instrument. These are the various cases there under compound financial instrument. So this is the ACM method as a whole, right? So this is the most important part. Now let's discuss this ACM method. Okay, so now how the accounting is done. See, I'll show it to you. Wait, I have tried to simplify it for you in a very innovative way, you can say. See, directly come towards this part. Yes, India's accounting as per ACM method. Not going to the background, I also gave you some logic behind why do we follow this and everything. That is not required. But now directly come to the ACM method. Now one hint I'm telling you, whatever method you follow, what is the full form of ACM? Amortized cost method. So by reading the name, we will think we have to recorded cost. No, whatever method you follow for financial asset or liability, on day one you will record at fair value only. That means even under ACM method, on day one the FA or FL is recorded at fair value. So sir, what is the sense of naming this as amortized cost method? Because on year end you will keep it at amortized cost. On year end you will keep it at amortized cost. How do we calculate this? I will teach you, don't worry. Now, as I said, for ACM you have to record at fair value. Now the question is, how do we calculate the fair value, right? So I have summarized this whole index into two categories. If you can understand this, it is going to be a boon for you, right? I can promise you no one will teach you like this, right? So how do we calculate the fair value? See, if you fall under these three cases, case number 1, case number 2, case number 3. If the question belongs to from any of these three cases, you will calculate the fair value. That means let me read this out for you. If there is any relationship between the two parties involved, between the borrower, between the lender, if there is any relationship, okay, relationship means parent, subsidiary, lessor, lessee, employer, employee, right? So if there is a relationship between the borrower and the lender, or if the instrument involved is a compound financial instrument, or if the fair value is based on level 1 input. What is the meaning of level 1 input? We will study in another index that part. As of now, just rectify this. If the fair value is based on level 1 input. So if you fall under any of the three cases, you will calculate the fair value, right? That means for you, the fair value will be equal to present value of future cash flows discounted at market rate of interest. Present value of future cash flows at EIR. EIR, full form of EIR is effective interest rate. I will also teach you what is EIR, don't worry. Okay. This is the first case where you compute the fair value. Acha. If there is a normal question where there is no relationship, no compound financial instrument, no fair value based on level 1 input, that means the question is normal question. In that case, you will not compute the fair value. You will assume the fair value. Sir, how do we assume the fair value? You will assume the fair value to be equal to your transaction price. You will assume the fair value to be equal to your transaction price. That means your fair value will be equal to the day 1 cash inflow outflow. Sir, what is the meaning of transaction price? To understand things better, let's take one example. Okay, so in my textbook you can find one example. In case you remember, I will show you one example, don't worry. So we had, let's say, example number this example number 2. Okay, you can read this example. What do we say? We say, let's say AK Limited invested in 10% debentures. That means he invested it as a financial asset for him. Okay, face value was rupees 50,000. These debentures are issued at premium of 10%. Okay, and redeemed after 3 years at a premium of 15%. Calculate the value of investment. Okay, now this is a normal question. How do we solve this? It is a case of financial asset. We have to solve as per ACM method. In ACM, as of now, when you read the question, was there any relationship between the borrower lender? No. Was it a CFI? No. Is there anything mentioned about level 1 input? No. That means, normal question, you will assume the fair value. Whenever you assume the fair value, there are 4 steps. There are how many steps? 4 steps. First step, cash flows. Step number 2 is finding the fair value. Step number 3 is effective interest, that is EIR. Step number 4 is LAT. Remember 4 steps: cash flows, fair value, EIR, LAT. Okay. Now under cash flows, what do we write? Just write, like for example, let me take an, okay, this was the case, example number 2 here. Yes. So let's say for example it is a financial asset. So under cash flows, you will just write, when it is a financial asset, you will invest on day 1. So what is the outflow on day 1? And because you invested, over the period you will keep on receiving the coupon and principal back. So what is going to be your inflow? Just prepare a summary of the cash flows. How much will you give? How much will you receive? Right? So I invested 55,000. How come 55,000? Because I invested at a premium. So face value plus premium. This 55,000. Whatever is the inflow outflow on day one, this is known as the transaction price. Do remember that part. Okay. So I will add the cash flows. So in this question, it was on day one I will invest. Over the period, I will receive a coupon and then I will receive my principal repayment at a premium. Right? This is my step number 1, cash flows. Now step number 2, fair value of financial asset. Because there it is falling in neither of the 3 cases, you will not compute the fair value, you will assume the fair value. Assume the fair value to be equal to transaction price. So your fair value in this case will be equal to the day 1 inflow outflow. This is nothing but transaction price. So that will be 55,000. Simple. What about EIR? What is EIR now? See, in this question, the coupon rate was 10%, right? But can you see in this question, there are some premiums also, right? On issue, on redemption. So this premium, the standard says, is nothing but interest only. So you should not book the premium on a specific date. That premium should also be booked across the period. Same is the case with discount. Have you heard discount on debentures, discount on preference shares? So whatever is the premium or discount, these are not discount or premium. Effectively, these are interest only. So the standard says your effective interest rate is a combination of coupon plus premium plus discount. So a combination of this is a effective interest rate. That means your premium, discount, everything should be booked over the period and not on a specific date. That is why we compute EIR. What is effectively your interest in this case? Why? Because see, you are issuing at premium, but you are redeeming at premium also. That means on receiving the principal back, you are receiving little extra. That extra is also nothing but interest only. So what is effectively what you are earning? So by interpolation, you will solve this. So we have already thought what is interpolation. To find the EIR, just use the basic formula of fair value. What was the fair value? Fair value is equal to present value of future cash flow at EIR, right? Fair value we assume to be the day 1 inflow outflow. Future cash flows already we have in the form of cash flow table, right? This we have to find. So if there are 3 pointers in this whole formula, 2 we already have. Fair value we assumed 55,000. Future cash flows we already have. These are the future cash flows, right? So we want the EIR. So by using interpolation, you will find the EIR. So you can assume any percentage. You know interpolation, right? We will use interpolation and find the EIR, not getting into the basics of the interpolation now. Okay, so you will find EIR. And then step number 4 is going to be LAT, loan amortization table. How do we prepare it? 5 columns are there. Year, opening, interest, repayment, closing. Now have a look carefully. Year 1, of course year end we are talking about. First at the opening. What was the opening on day 1? In opening, don't write the face value, write the fair value, because the financial asset or liability is recorded at fair value. So write the fair value here. Then you will take interest at the rate EIR. See, what is EIR? This is effective interest rate. Ideally you are going to repay coupon back to the lender, but effectively that coupon was not the effective interest. Effectively interest should have been the combination of coupon, premium, discount, right? So this EIR, the computation of EIR, the computation of interest is done as per EIR. How do you calculate this? Apply the EIR on the fair value and not face value. See, coupon is applied always on face value. EIR is applied always on fair value, right? So you apply the EIR rate on fair value, you will get the interest. This is the interest that you will book in the books of accounts. Then you will less repayment, you will get the closing amount, right? This is how you do it. Okay. So if you see effectively, your total interest income is 17,500. How come, sir? Your coupon was only 5,000 per annum, that is 15,000, but you also earned some premium at the end. So combination of that total is nothing but your interest, that is your EIR, effective interest rate, right? Do remember that part. So again, how many steps are there? Just to summarize things for you, 4 steps. Cash flows, just a summary. Step number 2, fair value, in this case we assume it. Third, EIR, calculated if not given. Fourth is LAT, simple, 4 steps. Cash flows, fair value, EIR, LAT, done. How do we do the accounting? Simple. Because it is a financial asset, you will record debit the financial asset to cash bank. Always record the financial asset or financial liability at fair value. Do remember that part. It is simple. Then you will book the interest. The entry of interest is simple. It is an income for you. So your financial asset will increase. First accrue the interest. So you will say financial asset to interest income, and then you will receive the repayment. So you will say cash bank to financial asset. You are receiving the repayment, right? If this was a financial liability, interest would have been an expense for you. Repayment you will pay. Simple. Okay, I hope the basic stuff is clear to you. So this was example number 2. Then we came on towards one more case where we discussed about transaction cost. So What is the meaning of transaction cost? Let's say, for example, you are issuing some debentures. So you will have to incur some processing charges also for issuing the debenture, for raising the funds. So that is nothing but transaction cost. So if you incur any transaction cost, what should be the treatment? Do not transfer this directly to profit and loss. No, 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 no. This transaction cost has been incurred for the whole instrument. That means along with the interest, even this transaction cost should be amortized over the period of loan. How do we do it? So this transaction cost will also form part of your EIR, right? Effective interest rate. That means effective interest rate comprises of coupon, premium, discount, as well as transaction cost. Now, what do we do with the transaction cost on day one, which we have paid off? So, simple. In case of financial liability, you will less the transaction cost from the value of financial liability. Let's say, for example, in this example number 3, we issued the debentures at a discount of 10%. That means you will receive only 90,000 inflow. Out of that also you incurred 5,000 transaction cost. That means this transaction cost, you will first record cash bank to financial liability 90,000 fair value pay, right? Then the transaction cost do not transfer to PNL. You will pass the entry to cash bank because you are paying off the transaction cost and debit the financial liability. That means this financial liability is getting reduced by the amount of transaction cost. Now, why is it getting reduced, sir? I also gave you the basic logic about it. Expense always has a debit balance, but liability has a credit balance. So if you want to capitalize any expense in liability, it will be less from liability. Unlike asset, in case of asset, if we capitalize anything in asset, we add it to asset now. So in case of financial asset, you will add the transaction cost. But in case of financial liability, you will less the transaction cost from day one financial liability. Why are we adding or lessing, sir? Because we don't want to book this whole amount in profit and loss on day one. We want this amount to be a part of your EIR over the period. So when you adjust it with the fair value, then only it will form part of EIR. I will show it to you how. So step number 1, cash flows. Okay, adjust this 5,000 from the fair value of financial liability. That means when you prepare step 2, fair value of financial liability, it is again neither of the 3 cases. So you will assume the fair value. You will assume the fair value to be equal to transaction price of 90,000. But in case of financial liability, if there is any transaction cost, you will less it, right? So it will become 85,000. Now you will find the EIR. EIR again same formula you will use. Fair value is equal to present value of FCF at EIR. Now when you take this fair value, you will take this fair value to be 85,000 and not 90,000. So as soon as you take 85,000 here, the EIR which you get in step number 3 will automatically account for the transaction cost as well, right? Okay. So accordingly, you will prepare your LAT. You will get the amount of interest. This interest is including your coupon, premium, discount, or transaction cost also. Okay, do remember that part. Everything is same. So in this case, in this example, what did we learn extra? We learned extra the amount of transaction cost, the treatment of transaction cost. In case of financial liability, you will less it on day one from financial liability. In case of financial asset, if you can see, I also discussed from the point of view of financial asset. From point of view of financial asset, you will add it in the fair value of financial asset. So the summary is also given here. And again, I have also explained what is EIR. It is a combination of coupon interest, discount, premium, and transaction cost. That is effective interest rate. Acha. What if in question there is no discount, no premium, no transaction cost? So in that case, if these 3 are not there, then can I say your coupon and EIR are going to be the same? This is only valid from conceptual point of view. Is this clear to everyone? Yes, sir. Clear. So we studied this basic part. Now this was the part where we are assuming the fair value, right? Based on this, we did 2 questions. As I promised you, I will also revise questions. So now I will revise illustration number 39. Can you see this illustration? I will just revise it. I'm not going to solve it word by word. This is a revision purpose, okay? But if you have studied it anytime soon, you will definitely recall it, okay? Don't worry. So what was given here? We have a financial liability here. Amounts are given, interest is given, but there is a transaction cost. First tell me how to solve this now. They are asking us the accounting. So always remember, whenever you see a question, 4 steps. What are the 4 steps? Step number 1, cash flows. Step number 2, fair value. Step number 3, EIR. Step number 4, LAT. Okay. Cash flows, you will financial liability. So you will receive the cash flow on day 1. Over the period, you will repay the coupon, you will repay the principal. So these were the cash flows. I wrote it down simply. Acha. But you also incur transaction cost, right? So because of financial liability, you will add it or less it. Perfect answer, you will less this transaction cost from the fair value of financial liability. Step number 2. So fair value will be your transaction price less your transaction cost. That is 9,500, right? Now EIR. Will the coupon and EIR be same? The answer is no. Why? Because of transaction cost. Here coupon is also there, yet transaction cost is also there, so it will be different. So calculate by the interpolation method, you will get the EIR, then yes, prepare the LAT, you are through with it. Simple question, done and dusted. This was illustration number 39. Now let's come on towards the illustration number 40. Now how do we solve illustration number 40? So what was there in 40? Let's read that part first. This was illustration number 40. So here also we took a loan, similar question, but there were some differences. What was the difference, sir? First, we took a loan of 10,000. Transaction cost was again 500, but the repayment is not happening in a very simple manner. So in the previous examples or questions, what we used to do, we used to repay the coupon in the initial years, and in the last year we used to pay the whole principal. Here what they are saying is, whatever loan you took of 10,000, the principal will get repaid in 4 equal installments. That means this 10,000 is not going to get repaid in one shot at the end. This will get repaid over the tenure, and that also half yearly installments. That means if the tenure is 2 years, you will repay in first year. In first 6 months, you will repay this much. In next 6 months, you will repay this much. That is how it is happening. So the principal is getting repaid half yearly, and the best part is here there is also coupon interest, but coupon interest is being charged and paid off quarterly. So the coupon payment happening quarterly, principal payment happening half yearly, right? But the best part is EIR here is not to be calculated based on your interpolation. It is given directly. Now, how to solve this question? Never take stress about such questions. It is simple. Just remember the steps. Sir, how many steps? 4 steps. Cash flows, fair value, EIR, LAT. Acha. Fair value should with computer assume. Did I say there is any relationship or CFI or level 1 input? The answer is no. So we will assume the fair value. Okay. Now how do I solve this? First step number 1, cash flows. Okay. But cash flows step was very simple, na? Directly write whatever you receive on day 1 and what are you going to pay over the period. But whenever the principal is getting repaid in between only, the cash flow table will not be very simple. The cash flows will not be very simple. Likewise in 39, can I say we were only repaying the coupon, and then at the end of 5th year we repaid the principal, so the cash flows were very simple, right? So I had taught you in class, whenever principals are getting also repaid in between, so in step number 1, an additional working note will be prepared in the name of cash flow table, right? Where you will prepare the columns quarter or half or year ended. Then you will at the face value write the interest coupon and then calculate the repayment, right? Then you will get the closing. Please remember, this seem to be very similar to LAT, but this is not LAT. Why? This is a cash flow table. Here our motive is to calculate the cash flows happening in each half year or each quarter, which are not given directly, right? So that is why here in LAT we used to take opening under fair value. Here we take the face value. In LAT we book the interest as per EIR. Here we will calculate the interest as per coupon, because our motive is to find the the cash flows, right? So I will write the face value, write the coupon, 12% per annum, that means 3% per quarter. Repayment will happen of 2 things, principal, interest. In the first quarter only interest will happen, because interest is quarterly, principal is half yearly. So every half year you will also pay the interest, and every half year you will also pay the principal, but every quarter you will also pay the interest. This is how it will happen, right? So this repayment is the motive to prepare this working note number 1. So just one small OFU, always prepare this working note number 1 whenever principal is also paid in installment. Simple. Okay. Then step number 2 was fair value. It is simple. You have to assume it to be 10,000, but it is a financial liability and there was also some transaction cost, so less it. So it will be 9,500. EIR, luckily it is given, but per annum it is given. This question is fully based on quarterly, half yearly. So find it per quarter also. Then prepare the LAT. It is going to be very simple for you. Done. Is this clear to everyone? Yes. That means this was the basic first part of your ACM method, where we do not compute the fair value, but we assume the fair value, right? Is this clear till here? Then I can proceed further with the next part of ACM method. Is this clear till here, guys? Yes or no? Tell me very quickly. Yes? Perfect. Now the next part under our ACM method is where there is a relationship between the borrower and the lender. So what is the meaning of this? That means the party who is taking the loan and the party who is giving the loan, both are related. Okay, related means there might be some relationship of parent, subsidiary, employer, employee, for example, right? So whenever there is a relation, I already told you, if it falls under the 3 case, relationship, CFI or level 1 input, you will compute the fair value. That means here your fair value will not be equal to your transaction price. Here your fair value will be equal to present value of future cash flows at EIR, right? Okay. Now To explain this in a better way, we took an example where I said AK Limited granted a loan to its employees, Mrs. Mru. Okay, of rupees 10 lakhs at the rate 5% repayable after 5 years. Principal is repaid after 5 years. Interest is charged and paid annually. Market rate 10%. Now, if you can see closely, I gave the loan to my employee at 5%, but in market the rate is 10%. Then why did I give the loan at a lower rate? Because there was some relationship. What was the relationship here of employer-employee? Now, how do we solve this part? So here, the steps will be common, 4 steps, but one additional step will be there. And why it will arise, I will also give you the logic. See closely. First step, you will add the cash flows, whatever is the inflow, outflow, you will give a summary of it. Step number 2. Do we assume the fair value or compute the fair value? Very good answer. You will compute the fair value. Sir, why do you compute the fair value? Relationship is there. So you will compute the fair value, present value of future cash flows at EIR. That means whatever the future cash flows are there, you will discount it at the rate of your EIR. Okay, so we discounted it. You will get some answer. 810460, I got the answer. Now look closely. The loan amount which you gave to the employee was 10 lakhs. But the fair value of financial asset is only 8,10,460. Now the issue is you gave the cash bank of 10 lakhs. You recorded the financial asset at 8,10,460. Some difference is arising. Some balancing figure will arise in the entry itself. Right? Because the outflow is 10 lakhs but the recording value is 8,10,460 because we record the FA and FL only at fair value. So what about the difference, sir? So the treatment of difference will be depending on the relationship. So here the relationship was employer-employee. So very good answer. The company will treat this difference as a prepaid employee benefit expense. That means when the company gives benefit to its employee, the company will treat it like a prepaid employee benefit expense. Sir, why prepaid? Because the company gave the loan for 5 years. That means this is an expense for the company for 5 years. If I want to give a logic behind this, what is this 189,540? This is nothing but the foregone interest by the company in present value terms. This is the interest which the company could have earned by giving the loan to someone else. But because it gave the loan to its own employee, it has foregone this much interest. So this is the expense for the company, but not of day one, of whole 5 years. So prepaid employee benefit expense. So what to do with this? Book this as a prepaid, then write off this over the period of 5 years through profit and loss. So P&L to prepaid will be the entry at each year end. That means when you calculated fair value, it was not same as your transaction price. It was different than your transaction price. So some difference arise now. So that is the extra step here. That is step number 3. So originally step number 3 was EIR, but wherever you calculate the fair value, there will be one extra step, step number 3, that is difference between fair value and transaction price. So yeah, the difference was this much. We discussed the treatment also. Then step number 4 EIR, step number 5 LAT, it is same, one and the same. Okay. That means in case of relationship also, if I want to summarize the steps, not 4 but 5 steps: cash flows, fair value which you compute, difference based on the relationship, then EIR, then you will prepare the LAT. What will be the EIR here? The market rate of interest which was given will be the EIR here, right? Got it, sir. Got it, sir. Got it, sir. Now we will also do some questions from your lovey-dovey module. So what were the questions which were there? So one question is illustration number 33, if you can see. Now here the point is of security deposit. Do you know, as I already told in India's 32 revision, the tenant will give the deposit to the owner. Tenant means lessee. The deposit to whom it is given is the lessor. So the tenant gives deposit to the lessee. Now this deposit, can I say it is interest free? When the tenant gives this deposit to the lessor, it is interest free. But let me tell you, if this tenant would have invested this same amount somewhere else, it would have got a return of 12%. Then why did it give the deposit interest free? Because of the relationship of lessee lessor. Because they were in a relationship of rent agreement. That is why the deposit was given for interest free, right? Now how to account for this? Just read the question. Okay, so the deposit was interest free, but in market the rate is 12%. 5 years tenure, simple. How do we solve this? So I already told the relationship is of lessor lessee. From whose point of view the question will be asked? Mostly the question will be asked from the point of view of lessee, right? So for lessee, day one he will give the deposits outflow. Over the period he will not receive any coupon, he will only receive the principal back. Then second step, fair value. Assume or compute. Relationship is there, you will compute it, right? You computed the same, you got this value. Now step number 3, difference. There will be difference between the transaction price of 10 lakhs and the day one's fair value, right? So this difference, how to account for this? The lessee will treat it like a prepaid lease rent. It is just like, because we have given the deposit, maybe the tenant must have charged us some less rent, right? So this amount represents nothing but the foregone interest which you have foregone just by making the deposit to your relationship wala party, right? So this is the amount of foregone interest which you will treat like a prepaid lease rent because the relationship is of lease, right? What do you do with this over the period? Write off over the period of lease term, whatever is there, right? So step number 3 is difference, step number 4 EIR, step number 5 LAT, prepare it, simple, done and dusted, right? Okay, sir. Then one next question was illustration number 116. Here the relationship was a parent subsidiary. I will not, acha, if you want, I will show you the question also. How the question looks like. Let me show it to you. Yes. Here we go. So here what was done was A Limited issued redeemable preference shares. What is the meaning of redeemable? Redeemable means redeemed in cash. Who issued? A issued to a holding company. That means the one who is issuing is the subsidiary. The one to whom it is issued, he is the parent. The one who issued, for him it is a financial liability. For holding it is a financial asset. For whose point of view it is asked? Asked from the point of view of Z Limited, that is a financial asset point of view, parent's point of view, right? So instrument was issued. What was the dividend rate? 0.0001%. But what is the rate in the market? 12%. Then how come the subsidiary issued these debentures at a lower dividend rate? Because of relationship, because of parent subsidiary relationship, right? So the relationship is of parent subsidiary. Again, how many steps? 5 steps. Step 1, cash flows. Step 2, fair value. You will compute the fair value. Step 3, difference. Now, what will you account for the difference as? If the relationship is of parent subsidiary, where the parent is helping the subsidiary, how come parent is helping? Because parent is giving the money to subsidiary at a lower dividend rate. So parent is helping subsidiary. Whenever the parent helps subsidiary, it is called a investment in subsidiary. We already discussed the logic also behind this, right? So entry will be such on day 1 where you will record 2 cash bank 10 lakhs, debit the financial asset, whatever the loan you gave at fair value. The difference will be investment in subsidiary. You will record this investment in subsidiary on day 1. On year end, you will do nothing with this. No writing of nothing. Just keep it at this value only. Okay. Step 4 EIS, step 5 LAT, prepare it, pass the entries. You are done through it. Simple. Yes. Then there was illustration number 122 where the relationship was of employer-employee. The question was very simple. Only one part was there, which if I may make you read it, you will also come to know what was the important part. Wait, I will show it to you. Illustration number. Sorry, I went little ahead. It was 122, I guess. Yes. So here, as a staff welfare, company is giving loan to its employee at 5%. Okay. But the critical part here was the prepayment of principal will happen in 5 equal installments. That means principal is getting repaid every year. So whenever principal is getting repaid every year, in step number 1, you will also prepare perfect answer working note number 1, right? So that is the only new part here. So under step number 1, for cash flows table, in step number 1, you will also prepare a cash flow table where you will also take the principal repayment, coupon repayment. So this, for this repayment, I am preparing this table. Okay. Then step number 2, fair value. You will discount all the repayments to find the fair value. Right. Then step number 3, again difference will come. We already know when the company helps employee, it is prepaid employee benefit expense write off over the period of 5 years. Step 4 EIR, step 5 LAT. Okay, then pass the entries, you are through with it. Okay, I also discussed an extra part here. What if they ask us the balance sheet extract and profit and loss extract? Then in that case, at the end of year 1, we have this much closing balance of financial asset. Where will it appear? Will it appear in current or non-current? So you will have to give the bifurcation. Some part of this is the closing on year 1 end. Some part of it is non-current, some part of it is current. How do I get the difference? So I gave you one simple trick to follow. Whatever the difference between year 1 closing and year 2 closing will be the current amount. So for example, let's say this was the total amount. Out of this total amount, the difference between year 1 and year 2 will be current amount and the balancing figure will be non-current amount. So also you can remember like this, whatever is the immediate next year's closing balance, that is the non-current amount, difference is current amount. Any ways you can take, right? So I have also given the calculation here, right? So you will bifurcate between current and non-current. Same logic applies for the prepaid part as well. The prepaid part is there, you write off over the period of 5 years. So 1/5 amount you must have written off. The balance amount will still be appearing here. If you want, see, the balance amount will still appear at the end of year 1. So this full amount is not non-current. Some of it is non-current, some of it is current. So just take the difference of year 1 and year 2, that is current. Balancing figure is non-current, right? Of course, practice it. You will come to know. Now, one more important thing I just want to tell you is bifurcation of loan between current and non-current. What ICA has done is, whenever along with the interest, whenever even principal is getting repaid every year, at that time they will do the bifurcation of current non-current. But what if in this question it was a normal question where principal was not getting repaid every year, where only coupon was getting repaid and the principal got repaid at the end? If that was the case here, where the principal is not getting repaid every year, in that case, what ICAI does is they take the whole closing under non-current. They will not give the bifurcation under current non-current. That means, again to summarize, if principal is getting also repaid every year, you will bifurcate the closing between current non-current. But if only coupon is getting repaid every year, principal is not getting repaid, but it will get repaid at the end of 5th year. That means the closing full will be non-current only, no bifurcation required. This note I have also given here. Just remember that part. A similar question is there, question number 4. That is also important, but you can try it on your own. It is exactly same like question number 122, right? So this part of relationship is done. Then I also gave you a summary of relationship and their accounting treatment. Like we discussed for employer-employee, it is the difference is prepaid employee benefit expense. For lessee-lessor, the difference is prepaid lease rent. For parent subsidiary, it is the difference is interest in subsidiary, right? So I gave you a summary of all this. Now let's discuss the summary of the relationship quickly. So the first summary of relationship talks about what if lessor and lessee relationship is there, right? So how to treat the difference amount for lessee. So lessee will call the difference amount as prepaid lease rent. And what to do with this prepaid lease rent on year end? Write off over the period of the rent agreement or the deposit amount. That is in our case it was 5 years. Write off over 5 years. Acha. We discussed from lessee's point of view. But what about lessor? Generally question is not asked from lessor's point of view. But by chance if it comes, for lessor the deposit was financial liability. So difference will come on the credit side. So if the lessee was treating the difference as prepaid lease rent, lessor will treat it like a advance lease income, advance income, and such advance income will be written off through P&L over the period of 5 years. Simple. But there is no question from lessor point of view, to be honest. Okay. The next relationship was of parent subsidiary, where the parent is helping the subsidiary. So as we already discussed, for parent, the difference will be investment in subsidiary. What about subsidiary? When the parent receives help from, when the parent gives help to subsidiary, that is, when the subsidiary is receiving any help, for subsidiary, this loan was a financial liability. So difference will also come on liability side. So subsidiary will call the difference as capital contribution from parent. What is the logic behind this? Just imagine now, for example, your parents are helping you. So your parents won't say that we are expensing the money on our child. They will say we are investing on our child. Similarly, the child will not say I am receiving any money from parent. They will say I am receiving capital contribution from my parent. Simple, right? Okay. Our rare case is also there where they say, what if subsidiary helps the parent? What if subsidiary gives the loan to parent? In the above case, what was happening? Parent was helping subsidiary. But what if subsidiary is helping parent, subsidiary gives loan to the parent? Then what will happen, sir? In that case, when subsidiary helps the parent, for subsidiary it is a financial asset, difference will come on the debit side. So now subsidiary will not say investment in parent. No. Subsidiary will say dividend distribution. Right? Likewise, the difference for parent will be dividend income. Sir, why so? Just imagine now, whenever, let's say for example, you become a chartered accountant. Now you start giving back, you start helping to your parents. So will your parents say that I am receiving investment from my sons? No. Will you say I am investing in my parent? No. When you become a CA, when you start helping your parents, what will you say? I am giving the returns of what my parents had put in. That means you are distributing dividend. Similarly, what will parents say? Parents will say we are receiving the dividend income of what we invested in past, right? You will not say by helping a parent that I'm investing in my parent. Subsidiary never invest in parent. Na? Subsidiary will give returns to the parent. Okay, logically clear, sir. Oh yeah. Okay, sir. Let's proceed. Then the next point was, what if the employer helps employee? For generally question comes from employer's point of view. Employer will say prepaid employee benefit expense set off over the period of 5 years. What if it comes from employee's point of view? Never asked, but if it comes, you will say it is advance salary. Okay. There is also one more case. What if government helps a company, right? So this case will be discussed in detail in Ind AS 20. That is government grant. Okay. Still telling you, if the government is helping the company, in that case, for company, by how will the government help? By giving a subsidized loan to the company. The government provides a loan to the company at a very low interest rate compared to the market rate. So for company, it is a liability. Difference will come on the credit side. That difference will be treated like a government grant. How to account for this will be discussed in Ind AS 20. Don't worry about it. So this was the summary of relationships which I have prepared, done a lot of effort by giving the differences through journal entry so that you can remember it very effectively for exam as well, right? Okay. Then we also did one illustration number 36. I will show that illustration to you as well. One sec. Yes. Illustration number 36. What was there in this question? A very good question from exam point of view. Please do read this. Okay. It says company provides a loan to the subsidiary. That means parent gives loan to subsidiary. That means parent is helping subsidiary. Interest free loan. Okay. Then three cases are there. They are asking the accounting in the individual books and also in the CFS. Acha. Three cases are there. First case, loan is repayable on demand. Now what is the meaning of repayable on demand? Demand means whenever parent will ask for the money, then only subsidiary will repay. Otherwise no repayment is required, right? So because there is a relationship here, normally what do we do? Because there is a relationship, we will compute the fair value. But in case number 1, to compute the fair value, what we require? Present value of future cash flow, that EIR. We don't have future cash flows because the repayment schedule is not fixed. Tenure is not given. How many years repayment will happen? Because the repayable on demand, right? EIR is also not given. So by default, you cannot calculate the fair value. So in this case, by default, even if there is relation, you will have to assume because there is no other option left. So you will assume, because you are assuming, difference will not arise. Okay. In case 2, all our problems are solved. Tenure is given, market rate is given. Okay. So in that case, in case number 2, you have the tenure. So if you have the tenure, you know the future cash flows because the coupon is going to be nothing, but the principal repayment will happen at the end of the 3rd year, right? ER you have already. So you can find the fair value now. You will compute the fair value. Difference will arise. For parent, the difference will be investment in subsidiary. For subsidiary, the difference will be capital contribution from parent. Step number 4 is ER. Step number 5 LAT. Pass the entries, done through this. There was also case number C. It says the loan is repayable when ABC has funds to repay the loan. The question says you will find it very similar to A. A says loan is repayable on demand, but C says loan is repayable when ABC has funds. They are not the same. We say na, we are not the same, bro. Case C and case A are not the same. Why? In case A, the payment will happen when the parent demands for it. In case C, the payment will happen when subsidiary wants to repay. So the standard says here, because there is no tenure, there is no rate vagera. So the standard has given just a 2-3 line theory solution for this. You just need to read that part. What does it say that? It says case C is not same as case A. So in case C, the company will have to estimate the repayment schedule, the EIR and everything, and do the measure accordingly, like we did in scenario B. So just remember this 3-line theory part. Okay. That was case C. Acha, they had also asked what will be the treatment in CFS. So in CFS, it is an intercompany transaction. Everything gets eliminated. No treatment in CFS. Simple. Okay. Done, sir. There was also a similar case, question number 8 of MTB RTB past exam. Exactly same question, but only 2 points were different. In case 2, if we find the fair value, we will get the amount as this much. But in question already fair value is given. Which one to take? If in question fair value is given, always use the fair value of question. Okay. I have already discussed this. The only difference part. Second thing different was in question number 8 was that also asked what if instead of parent helping subsidiary, what if subsidiary was helping parent? So can I say already discussed it in the summary part? If subsidiary helps parent, the difference will be dividend distribution for subsidiary, and for parent it will be dividend income. Simple. Amounts are not given, only this theory you have to write. That's it in question number 8. Okay, done. So this was the relationship wala part, right? We are through with this. Let's proceed further with our revision. The next point is, what if the fair value is based on level 1 input? Now what is the meaning of level 1 input? That we will understand in Ind AS 113. As of now, just remember as of now, right? So if you haven't studied Ind AS 113, it's fine. Just remember, if the question says fair value is based on level 1 input, so can I say here also we will compute the fair value, right? In 3 cases we compute, right? Relationship, CFI and level 1 input. In these 3 cases we compute the fair value. So here just remember 2 points. 1, you will compute the fair value. Same formula, present value of future cash EIR. Second, the difference irrespective of any relationship will be directly transferred to profit and loss. Difference between what? Because you will compute the fair value. Can I say there will be some difference between the transaction price and fair value? Such difference directly transferred to profit and loss. That means if I want to give the step summary, again 5 steps only. Cash flow, fair value computed, difference will arise, but directly transferred to profit and loss, EIR, LAT. Done. Okay. There were two questions. First question is illustration number 29. Okay, let me revise that illustration for you as well. One sec. Yeah. In this question was given question of security deposit, again relationship of lessee lessor, but I gave you two scenarios. First scenario, assume that fair value was based on level 1 input, and second scenario, assume there was a relationship between lessor lessee. So in the first scenario, you will solve as per 5 steps. Step number 1 2 3 4 5 all are same under both the cases. All 5 steps are same under scenario 1 and scenario 2. The only difference that will arise is in step number 3. If you say that the fair value is based on level 1 input, difference will be transferred to profit and loss. If you say the fair value is not based on level 1 input, then you will treat the difference based on relationship. That is, you will treat the difference as prepaid lease rent because the relationship was of lessor lessee. Simple. That's it. Nothing else in this question. Similar question is there, question number 4, where also I made you write that assume the fair value is based on level 1 input, right? So that part was missing in the question, but I made you assume it, right? This part was missing in the question, but I made you assume it because it is impliedly assumed in the solution, right? So I made you assume that what if the fair value is based on level 1 input. Accordingly, we will solve it, right? Acha, was it question number 4? I guess the question number was not 4. Let me just check. Let me just verify. It was not 4. Wait. It was question number 12, I guess, if I'm not wrong. Yes, it should be question number 12. Okay. So that was question number 12. Very simple question. If you read on your own, you will come to know. It is very simple. In that also, I made you write that assume the fair value is based on level 1 input. Ideally, it should be written in the question, but they have assumed the same in the solution. So I made you write in the question only. So in that case, again, 5 steps, the difference will be transferred to profit and loss. That's it. Done. 12. It should be 12. Yes, perfect. Then let's proceed further. So this was level 1 input. So normal ACM question where we assume the fair value. Done. Relationship wala part. Done. Level 1 input. Done. Now we come towards CFI, compound financial instrument. Now what is the meaning of compound financial instrument? That we already discussed. An instrument where we have both the elements. We have the element of FL also. We have the element of equity also. Right? And we already know CFI can only be from the point of view of issuer. For holder, it is a financial asset. So CFI concept only exists from the point of view of issuer. Now to understand this in a better way, we already have some examples in our textbook. We will have a look at those examples. The first part was for compound financial instrument. Example was given, AK issued 10% debentures for face value, redeemable or convertible. But the market rate is 14%. That means coupon is 10%, market is 14%. Okay. Case A, option to convert is with the holder. Now have a look here. If the option is with the holder, can I say interest anyways FL? Principal, because holder has the option. Can I say issuer at its own will cannot avoid paying cash? So principal will also be FL. So if we say interest and principal, we will call it a normal financial liability. But here comes a twist. If you see closely, the coupon was only 10%. But the rate in the market is 14%. Now, why will my holders accept a lower rate debenture? Why will my holders accept a lower coupon rate debenture when they can earn 14% in the market? Because I am giving them a conversion option as well along with the normal debenture. I am giving them debentures with the conversion option. That is why they are accepting. That means, why was the company able to save this interest? Was it because of some relationship? No. The company was able to save the interest because they were giving the conversion option along with the normal debenture, right? So this savings part is the equity component. So ideally, an instrument which is convertible does not have 2 elements. It has 3 elements: interest, principal and savings part. Why this savings part is equity component? Because this savings was only possible because the issuing company gave conversion option along with the normal instrument. Right? So if you have 2 elements FL but little element equity, this becomes a CFI. This was only for your clarity point of view. If it is CFI, again, do you assume the fair value or compute the fair value? You will compute the fair value. How many steps we have? Same 5 steps. Step 1, cash flows. Step 2, fair value of financial liability. You will compute it. Same formula. Present value of future cash flow at EIR. Now what about the difference? Because it was a CFI. CFI means little FL, little equity. So here in CFI, the difference will be treated like a equity. Will be treated like a equity component. So step number 1, cash flows. Step number 2, fair value. Step number 3, equity. Right? Okay. Then we proceed with step number 4, that is EIR. Okay. Step number 5, LAT. LAT will prepare for financial liability. Simple. Clear with this part? That means whatever convertible instruments you issue, even if the option is with the holder, still it become a CFI. Why? Because interest was FL, principal was FL, but savings was equity. Okay. And in CFI, just remember one extra thing: the difference amount is going to be equity component. So can I say relationship, level 1 input and CFI all have 5 steps. The only difference comes in step number 3. In case of relationship questions, we treat the difference based on relationship. In case of level 1 input, we treat the difference, we transfer the difference to profit and loss directly. In case of CFI, we treat the difference as equity component. This is how I have simplified the financial instruments for you. Right? Can you imagine? Yes. Okay, sir. Now I also gave this part where if it is a CFI, what will happen at the end? See. So for example, you prepare your LAT. Now you will not get the closing as nil because we don't know what the holder will choose. So I will not make the principal repayment. I will keep it as it is. So my closing will come to the principal amount, 25 lakhs. Now at the end of 5th year, holder can either choose cash. So if he chooses cash, I have the liability outstanding 25 lakhs. I will pay it off. Equity component will be transferred to retained earnings. Okay. But what if the holder chooses equity option? In that case, your FL is no longer required. Transfer the FL to equity component and issue your equity shares. This is one way of doing it. Other way can be directly reverse the FL, directly reverse the equity and issue your equity shares. There is another way of doing it. Ultimately, the net effect is same in all the cases. Okay. This was the case number 1 where option was with the holder. Now comes the important part, case B, where option to convert is with the issuer of the instrument. Now, if the option is with the issuer, in that case, interest is FL, but principal becomes equity. Why? Because issuer at its own will can avoid paying cash. Now savings in interest is also already equity. So interest FL, principal equity, savings in interest equity. So again, it is a CFI. How to account for this? Now comes the very important part. Please pay attention here. Whenever you prepare step number 1, cash flows, you will only take the mandatory cash flow. What is the meaning of this? So that means principal for you was equity. No? You called the principal equity. That means principal repayment will not form part of your cash flows. Why? Because you never assumed, we told principal equity. That means under principal we are assuming there is no contractual obligation. So you will not take the cash flow of principal repayment. That means whenever any element you assume it to be equity, it will not form part of your cash flows. Simple. Right? So accordingly, you will calculate the step number 2 fair value, step number 3 equity. If you see the amount of equity are drastically increased, the amount of FL of fair value is decreased, amount of equity increased drastically. Why? The reason was because your principal also equity now. So your financial liability will only have the fair value of your coupon payments. Right? That is the reason. Anyways, then step number 4 and 5 are ultimately the same. Here, without even making the principal repayment, the closing balance of LAT comes to 0. Why, sir? Because principal you never assume it to be FL. Principal you never assume it to be FL. So even before making the principal repayment, this will come to 0. Now, what will happen at the end of 5th year? See, if the issuer, now issuer can pay cash also now in exceptional cases. If the issuer pays cash, of course we did not account for the cash. So in that case, you will give the cash from equity component. If anything is left over, you will bring that amount from retained earnings. Okay. What if the issuer gives shares? You will transfer the whole equity component to capital to premium. That's it. Simple. Right? Okay. Then we did illustration number 126 that you can do in homework. Simple question is there. And question number 13 also we did. It is simple question now. Okay. Now we come towards the important part, that is compound. Acha, one more thing. In illustration number 126, if you read this question, they have given that it is a convertible instrument. But who has the option for conversion? It is not mentioned. So whenever option to convert is missing, who has the option is missing, always assume that option is with the holder of the instrument. Always assume that. Right. Also, in this illustration 126, only coupon is paid. Principal will get repaid one shot at the end. So if they ask the balance sheet extract for you, whole amount will be shown only under non-current. As I said, do you remember, if the principal is not getting repaid, whole non-current? Do remember that part. Okay. Now comes the googly. Googly means you can say twist in turn, where there is a compound financial instrument with transaction cost. Oh yeah, that means a CFI involving transaction cost also. Now what is to be done here? Simple steps to be followed, right? What is to be done? Please have a look. I gave an example in the textbook. We have example number 5, where we say there is a normal instrument of 80,000 3 years, but we also incurred transaction cost of 2,000. How to solve these types of questions? Do you remember? For first 4 steps, assume there is no transaction cost. So my interest was FL, my principal was FL. Okay, because option was with the holder. So I assume there is no transaction cost. So I solved. Step number 1, cash flows. Step number 2, FL. Step number 3, equity component. Step number 4, EIR. Done. Now, the transaction cost you incurred of 2000, was it incurred only for FL? Was it incurred only for equity, or it was incurred for the whole instrument? It was incurred for the whole instrument. That means this 2000 is incurred for the whole CFI. It is incurred for the whole compound financial instrument. So this 2000 has to be allocated between FL and equity. Now how will you allocate it? In the ratio of this fair value. So that is my step number 5, extra step. You will allocate the transaction cost to FL and equity, right? So you will allocate it. Now what to do with this? So whenever you allocate transaction cost to FL, it reduces the value of FL because FL has a credit balance. This has a debit balance, so reduce it. Whenever you allocate TC to equity, you will again reduce it from equity. Why? Equity again has a credit balance. This TC has a debit balance, so reduce it. So after allocating the transaction cost, the fair value of FL and fair value of equity will be reduced. Because the fair value is reduced, your EIR will change, right? So that is my one more new steps. So 2 new steps are there here in case of CFI with transaction cost. The first new step is allocation of TC to FL and equity, and the second new step is calculating the new EIR. In my example, I had taught you how to calculate the EIR, but of course in the question given in the module, it is already given the new EIR including the effect of TC. So 2 EIRs are given. One is old EIR, which will be used to calculate the fair value given above, fair value of FL before TC, and then the new EIR which was given after the effect of TC will be used to prepare LAT. We already discussed all these things. Do remember that part. That means now I also gave you a summary, exclusive FR with the exclusive summary for 2 types of questions. One, CFI where there is no transaction cost, so only 5 steps. Cash flow, fair value, difference, that is equity, EIR, LAT. Then CFI with a transaction cost. How many steps? 7 steps, because 2 steps are extra. So first, cash flow, fair value, difference, and old EIR. See, here when you are calculating the fair value, use the old EIR only. Okay, then calculate the difference, that is equity, then write the old EIR. These 4 steps are common. Now, because there was transaction cost, allocate the TC between these 2 steps in the ratio of these 2 steps and find the revised fair value. Then step number 6, new EIR after transaction cost will already be given. Then prepare the LAT. LAT will prepare using the new EIR. Now, one illustration 121 was given. We will discuss that illustration, a very good illustration, a good candidate from exam point of view. Always do that question and go. Okay, wait, I will also show you that question. Here it is. See, now if you see clearly what is mentioned here, ABC company issued 10,000 compulsory convertible preference shares. Now this changes the game because the instrument is compulsory convertible. So if you see, interest is FL, but because it is compulsory convertible, principal is equity, savings will be equity, right? Because principal is equity. Do you remember now? If any element is equity, it will not form part of your cash flows, right? So year 0, year 1 to 5, and 5th year end, it will be 0. Why? Because principal will not form part of your cash flows. Do remember, maximum students will make mistake here. Okay. Step number 2, fair value will get. Step number 3, there will be equity component. If you read the question wholly and solely, it is given that 30,000 was our transaction cost. So now this 30,000 has to be allocated between FL and equity. I will allocate between FL and equity in this ratio, in the ratio of step number 2 and step number 3. I will get this value. Now, as soon as you allocate, the fair value of our FL and equity both will decrease by this allocation. So we decreased it, right? Then we want the new EIR. See, for calculating the old fair values, I used 15%. I used 15%. But while preparing LAT, I will use the new EIR, 15.86%. When 2 EIRs are given, it is so obvious now that the old one will be the first one and the after TC wala effect EIR will be the new one, right? Will be given below. Okay, so I wrote the new EIR already given in the question. Then we'll prepare LAT. Now while preparing LAT, 2 mistakes you will make. First, when you take the fair value, which fair value do I take? Do I take the fair value of step number 2, or will I take the fair value after allocating transaction cost? So always take the fair value after allocating the transaction cost. First thing. Second thing, when you take the EIR in LAT, always take the new EIR. Don't take the old EIR. Please remember this part. Okay. Yes. Then we pass the entries and it is through. So it is a simple part. So this was the case where it is a CFI with a transaction cost. Before I move forward, please remember when you're revising these questions with me, this should act as a support to you. This should not be a replacement of writing practice. Some of you might do, sir, you revised it, done, sir, no need to write and practice. No, this is not a replacement of writing practice, guys. So this is helpful just to keep you in touch, just so that you cannot make any mistakes, and wherever you are stuck, you will come to know, acha, haan, sir, I told this. But of course, writing practice is a must in each and every case. Okay, sir. Let's proceed further. Next point is compound financial instrument, right? Now, under compound financial instrument, one more case is there. Early settlement by way of payment of cash. Early settlement by payment of cash. That means, let's say for example, our original tenure was 5 years, but we settled the CFI in third year only by making payment in cash. So how do we do it? So we have question number 1 to understand this concept. So we will read the question number 1, and along with that, we will try to understand what is there in this part. Okay, come. So it is mentioned that question number 1, on 1st April 19, Shelter Limited issued 5,008% debentures maturing on 31st March 24. That is, the tenure was of 5 years. Okay. So it is convertible at the option of the holder. So it is a normal CFI. Interest FL, principal will be FL because option is with the holder. Savings and interest will be equity. Sir, why always savings in equity? Because it is a convertible instrument, no? So savings in equity. Okay, do remember. So follow normal steps. Step number 1, that is cash flow. Step number 2, fair value. Step number 3, equity. Step number 4, EI. Step number 5, LAT. LAT I did not prepare for the whole 5 years. Why? Because in mid only I came to know, at the end of third year only, we decided to make a payment of 5,25,000 and settle this whole CFI. This we did not know on day 1. So originally when we were calculating the fair values and everything, we took the tenure as 5 years only. But when we were preparing LAT, that time we came to know that we are settling it early, right? So at the end of third year, you are settling it. So the first part of the question is very simple. Just solve the normal CFI, right? Then the second part of the question, where you are settling it on an early basis. Just try to see on the date of settlement, what was the amount of equity, what was the amount of FL. So FL amount you will get by preparing LAT. Equity amount, it will stay the same as it was on day 1. So if I say on the date of early settlement, these were my values of equity, this was my value of FL. Clear? Okay. How much payment am I making? I am making the payment of 5,25,000. Okay. Now, out of this 5,25,000, do not pass direct entry, or do not reverse the FL equity and say to cash bank to PNL. No, this is wrong. This is now how you do it. This is not to do it. Not the way to do it. Not to do it. Not the way to do it, right? Okay. How do we do it then in that case, sir? The payment of 5,25,000 should be bifurcated between FL and equity, right? How do we bifurcate this? Do not bifurcate in the ratio of carrying amount. No. You will bifurcate in the ratio of fair value, right? How? Why do we do it, sir? In case you remember my example, let's say for example, I am selling iPhone and calculator to Ajay, right? The carrying value is this much, but the fair value is, let's say, 21,000 and 4,000. So how much will I demand from Ajay? I will demand from Ajay 25,000 based on the fair value. Now, whenever I'm selling anything, I will not see what is the carrying amount in my books. I will see what is the fair value in my books. Accordingly, I will sell it to Ajay. So I will demand 25,000. And if I ask you, out of 25,000, how much did Ajay pay for iPhone? So you will not say bifurcate in the ratio of carrying amount. You will say Ajay paid 21,000 for iPhone, Ajay paid 4,000 for calculator. Simple calculation. That means whenever you are settling or selling anything, the payment will bifurcated it between these two elements in the ratio of fair value. But the question is, we don't have the fair value. You will have to compute it. So out of 25,000, just imagine how much did you pay for FL? You will have to calculate the revised fair value of FL. Calculation is given here. It is simple. The day you are standing is 1,422. Just see what are the remaining cash flows. The formula is very simple. Present value of, we take present value of future cash flows, just add one word. Present value of remaining future cash flows. The day you are settling, after that, how much were the remaining future cash flows? So these were my remaining future cash flows. Just bring them to the present value, and the new EIR was also given in the question. New EIR means EIR on the date of early settlement. Use that new EIR and find the fair value. That means the formula for fair value remains the same. Just take the remaining cash flows after the settlement date and take the new EIR. You will get the fair value. That means out of 5,25,000, this much amount, whatever is the fair value of FL, this much amount you are paying for FL. So balance amount you will pay for equity. Now, whatever you paid for FL, pass two different entries for both these elements. Okay, whatever you paid for FL, you will say to cash bank the amount paid. FL will go out at carrying amount only. That means when you say FL to cash bank, the amount of FL is going out, it will go out at carrying amount, but the payment made is excess. Difference transferred to profit and loss. In case of equity, whenever you are settling any equity element, you made this much payment, equity amount will go out at carrying amount, the balancing figure will be transferred to retained earnings. See, whenever you are settling any equity element, the difference will also be transferred within other equity only. But whenever you are settling in a liability element, the difference will be transferred to profit and loss. This early settlement point is very important. You might find it tricky on the face of it, but it is very simple. If I want to simplify it, see, can I say the first part of the question is basic calculation. Under second part, just need to calculate whatever payment you made, how much payment did you make for each of the element. Just find one fair value of FL, revised fair value of FL. If you find this, everything is simple now. If you find this fair value, this much payment you made for FL, balance for equity. Pass the entries, whatever you paid, write to cash bank. FL will go out at carrying amount, difference, profit and loss. Whatever you paid for equity, write to cash bank. Equity will go out at carrying amount, difference, retained earnings. Simple, done, understood. Likewise, we also did one more question, illustration 84 and 86, continuation question, same like what just the question we just discussed. Okay, so you can refer it in for practice also. Then we did illustration 117. What is 117? It is a classic question again. It has also come in exam. So it is a good question. I will discuss that question with you as well. What does it say? It says we have convertible bonds. But maximum students got confused because it is not mentioned whether it is compulsory convertible or conversion option with the holder, option with the issuer. Not mentioned anywhere. You know where was it mentioned? It was mentioned here in the C part that the holders have the option. Mostly questions read this and they were not able to interpret who has the conversion option. Why? Because who has the option will change the solution. Na? If you assume option is with the issuer, then principal will be equity for you. Then the fair value of FL will be different, fair value of equity will be different, right? But if you assume holders have the option of conversion, then principal will be FL. Right, so that was the mistake part. Okay, so what was there in this? Coupon rate is given, ER is given. Okay, they want us to pass the entries for year 1. They also want us to calculate the stream of interest expense for the whole tenure, that is 8 years. How will I get this? Prepare the LAT, will get this. One extra part was there, that is what if the holders elect to convert at the end of third year only? That is early conversion they want to opt for. So normal question. Just say interest FL, principal FL, savings equity. It is a CFI. Cash flows, fair value, equity, ER, and LAT will prepare. Okay, simple. For part C of the question, where they are doing early conversion, so you will say, sir, again find the fair value of two elements. No, early settlement is different, early conversion is different. The early settlement point where we discussed previously, it was settled early in cash. The file 25,000 payment was made in cash. That is where you follow the above method. When the early conversion is into shares, when the early conversion is happening into shares, in that case, no need to calculate the bifurcation of how much for FL, how much for equity. No. Whatever is the value of FL on that date, reverse it. Whatever is the value of equity on that date, reverse it. Transfer it to equity share capital. Simple. You will understand this once you try to solve it. Of course. Okay. Illustration number 125. Normal question you can try in homework. That is fine. You can revise in homework basically. Okay. So this was the whole concept of CFI. Can I say, have you understood the concept of CFI, guys? Can you tell me yes or no, please? It is very much required, guys. Also, the ones who are watching recorded, comment section is yours. Did you understand till CFI? So if I tell you now, in maximum cases, 50% chapter is done till here. And one question definitely appears. I will also revise one more point here. Don't worry. But have you understood till here? Yes. So if I got to show you how much have we covered, Index 32 completely done, right? Index 109, how much we have done? This, and under ACM method, full ACM method done. Can you see this? Where we assume the fair value, where we calculate the fair value, where we calculate the fair value in CFI, level 1 input is done. In CFI also, all 3 cases done without transaction cost, with a transaction cost, conversion or early settlement of CFI, everything done till here, right? Yes. And can I say I have tried to simplify it for you by giving the steps? Yes. Okay. One more point we can discuss is this. What about other methods? We discussed ACM. But what about other methods? That will hardly take a span of, let's say, 5 minutes. Other methods are not very important compared to ACM. But yes, they are there. Not much questions also on that part. But we will revise. Let's give it another 5 minutes so that we can complete the revision of that other part as well. Okay? Come. We will revise it quickly. Just give me a moment. Yeah, we were here. Yes. So now we are moving forward with the other methods. ACM we already know. If I want to summarize ACM, on day 1 we recorded fair value. right? Fair value for FA is fair value plus TC. For FL, it is fair value minus TC. TC means transaction cost. On year end, we recorded amortized cost. Sir, what is amortized cost? You did not tell. Whatever is the closing balance of LAT, it is amortized cost, right? So your FA or FL stays at this value on year end. Stays at this value on year end. That is amortized cost. Okay, okay, sir. Let's proceed now. What about other methods? Fair value method. Now we have more methods left for, that is FVT, OCI, RNR. These methods are only there in financial asset. FVTPL, it is there in financial asset and financial liability both, right? Acha. In FVT, OCI, RNR also, on day 1 you recorded fair value plus TC. But if it is FVTPL, you only recorded fair value. So what about TC? TC is not capitalized, it is directly transferred to profit and loss. Okay. Then subsequent measurement for financial asset under all methods. So for financial asset, from initial measurement to subsequent measurement, everything I have tried to put in one chart. We have 4 methods for financial asset: ACM, FVT, OCI, R, FVT, OCI, NR, FVTPL. Acha. I will just give you a quick overview. Will not spend much time on this because not very critical from exam point of view. Just give it a go through and just complete it. Quick revision starts now. First, method by method we are going. ACM method. Initially recorded fair value plus TC. That is TC is getting added to fair value. Why? Because you want to capitalize it and book it over the period of loan. That is why. By way of EIR. Okay. Subsequent measurement in ACM method happening at amortized cost. Interest dividend, that is the column of EIR. You prepare LAT na. In LAT, where do the ER gets transferred? It gets transferred to profit and loss, right? Unrealized gain loss or realized gain loss cannot arise because here your motive is to only hold till maturity. So this cannot arise. Okay. ACM method done. Now FVT, OCI, R. Now if it is FVT, OCI, R, initial measurement same, fair value plus TC. TC you will add to fair value. Subsequent measurement, method name itself suggests fair value through OCI. That means subsequent measurement will be done at fair value and the fair value changes. The unrealized fair value changes will be transferred to OCI, R. So unrealized gain loss transferred to OCI, R. So what about the realized interest, realized gain loss? So the realized dividend interest income and the realized gain loss will be transferred to profit and loss. Always remember, whichever method you use, if you book any realized gain loss, always profit and loss. This OCI, R, NR is only relevant for the unrealized portion. Okay, okay. And realized gain loss will arise when you sell the asset. Okay. So if you sell the asset, because it was OCI, R, what to do with the old balance of OCI, R? So if it is OCI, R, you will have to reclassify the profit booked in OCI, R to PNL, because the full form of OCI, R is R means reclassified to PNL. That means when this financial instrument is going out of your books, at that time the whole balance whatever booked in OCI, R across the years will be classified to PNL. To remember that the difference between R and NR is only that in NR, when the financial asset is going out of your books, the difference will not be reclassified to PNL. It will be only transferred within other equity. What about FVTPL? In FVTPL, it is very simple. Name suggests book at fair value and whatever is the difference, realized, unrealized, transfer in profit and loss. So that is what we do. We book at fair value, whatever is the difference, transfer in profit and loss. Simple, right? Okay. Also give you an OFU that whatever method you are using, realized gain loss, always profit and loss. To remember that. Acha. What about measurement for financial liabilities? For financial liability, we don't have 4 methods. We have only 2 methods. Maximum case ACM, in few cases FVTPL. So if you are using ACM, then you will record at fair value less transaction cost. Subsequent measurement at amortized cost. Interest, whatever you get, it will be profit and loss. If you are using FVTPL, book at fair value and everything else will go in profit and loss. Simple, right? Now, initial and subsequent measurement for equity elements, right? Just remember, equity are like our owners. Whenever we call anyone an equity transaction, it is like our transaction with the owner. Whenever you do any transaction with the owner, whatever gain, loss or difference arises, never transfer it to profit and loss. Always adjust within equity. For example, whenever you pay any dividend to your equity owners, will you say that I have expensed out the dividend? No. We say it is appropriation of profit. That means whenever you receive anything from equity or you pay anything to equity, it is an equity element. Always adjust it within other equity. I will give a demonstration also. Just have a look at it. Let's say initial measurement. Initial measurement for equity happens at what value? In case of CFI, we book at a balancing figure, right? Because equity element, how do we get difference between transaction price and fair value? That is how we get equity. If you incur in transaction cost, we less from equity because equity has a credit balance, TC has a debit balance. So less it. Subsequent measurement, it is never remeasured. It's still the day one amount. Okay. What if you pay in a dividend? It is appropriation of profit. You will deduct your reserves, not your profit and loss. Acha, what if any gain loss arises on settling the equity element? Transferred within other equity. Classic example was early settlement of CFI. When you were settling the equity element, you transfer the difference to retained earnings. Remember? So any realized unrealized gain losses transferred within other equity only. Do remember that part. I also discussed one OFU. Sir, whatever we give to preference share as dividend in the name of dividend, whether the dividend paid to preference share will go in profit and loss or within other equity. So if the preference share are classified as FL, then whatever dividend you pay, it is an expense for you. But if the preference share are equity, then whatever dividend you pay, it is other equity. So what if it is a CFI? In CFI, when you prepare the LAT, you calculate the effective interest rate on the fair value of financial liability. That means whatever EIR is applied, it is applied on financial liability. So in CFI, whatever dividend you pay, it is paid on the liability portion. So it will go in profit and loss. Do remember that part. Then we did one question number 2 that you can try in homework. It is a very simple question. Solution I have attached here itself. Question number 10. Question number 10 is there. Again, not a LDR question. You can try in homework. See, the question which are not LDR now, we will not waste time in revising them. If you try it on your own, you will be able to revise it. Acha, there was one question number 17 that I surely want to revise it with you. Okay, come. Question number 17. See, whenever I say illustration means question of module. Whenever I say question means MTP RTP section. In my book, I have 2 sections. One section is of the questions of module. Second section belongs to questions of MTP RTP past exams. Right? Okay, sir. Now, question number 17. Classic question. Please read carefully. It says EBC issues 4% 1 lakh optionally convertible preference shares. The main part here was that dividend is non-cumulative. See, in case of preference share, when nothing is mentioned, we assume dividend to be mandatory. But here dividend is non-cumulative. That means it is not mandatory. Whenever any element is not mandatory, it is not a financial liability. It will become an equity item. Right? Sir, why equity? Because dividend you will pay only when you have funds to repay. Right? Dividend you will pay only when you have profit. That you do with the equity owners. Na? That you do with equity items. That is, you are treating the preference like your owners. That is why you will give the give amount only when you have funds. So dividend will become equity for you. Principal options to convert is with the holder in this question. So it is FL. Savings will be equity. So how to solve this question? Simple. Normal CFI question, 5 steps. Step number 1, cash flows. In cash flow, don't take anything coupon. Why? Because dividend is FL, is not a FL. It is not a FL, not mandatory. So nothing will come in coupon. But principal is of course FL. You will take this in your cash flows. Okay. When you find step number 2, fair value, you will compute the fair value because it is a CFI. When you compute the fair value in cash flows, only principal cash flow will come. Coupon will not come because coupon is not mandatory. Then step number 3, difference. Step number 4, yeah. Step number 5, LT. That's it. Then the entries were asked. We passed the entries as well. So what was the important part in this question? This part. When dividend is not mandatory, it is not a financial liability. Don't take it. Don't make it part of your cash flows. Right? This much we studied. I guess this was the 50% I was talking about. This is your part 1 of the revision. Of course, when we complete the remaining chapter, we will also record the part 2 of the revision. But if you liked the session, do drop me a message if you liked this revision. For those who are watching it on YouTube, if you liked it, please leave a comment whether you liked it or not. Notes, as I said, available on Telegram. And ooh yeah, 50% done. And I tried to keep it very detailed. I tried to go slow with it. I tried to give you the logics also. So if you were able to see this session, and even if you were able to recall, let's say 30, 40, 50% of the concepts, you are in a great position, right? It is just that when you study anything for the first time, you might understand 10-20% concepts. When you revise it again, you will understand another 10-20%. When you revise it multiple times, that is when you achieve that efficiency, right? So try to give my best in this revision video, which you can refer anytime, whenever you want. Okay, so if you like the session, do like it, share it with your friends as well, and also do the writing practice, whatever is required. Okay, so I will end this revision session as of now. Part 2, of course, I will upload it for you as well. So thank you so much. I am glad you liked it. Please don't leave this topic. It is a very easy topic. Try to give you logics also. Okay, so thank you so much. Bye bye everyone. Take care. See you all. Bye bye. Welcome everyone to yet another amazing session on CA Final Financial Reporting, and I hope my audio is absolutely amazing. So we are back here to revise financial instruments again, right? Again, in the sense you might have seen the first part of financial instruments revision, where I had revised till this point, till accounting of equity instruments. So if you haven't watched it, first watch that and then resume with this session, okay? Also, if you are watching this on YouTube, don't forget to subscribe to the channel. Also, do hit a like button if you like it, and also do share it with your friends. The board notes which I'm going to refer here, I will upload on my Telegram, so you can download it from there. Okay, just to remind you, in this revision lecture we are going to revise the concepts as well as the questions which are going to be relevant definitely from exam point of view. Okay, so without wasting any time, let's start. Let's continue the revision. Okay, so I'm starting the revision, continuing the revision in 3, 2, 1 and go. First of all, in the previous lecture we had revised till this part, accounting of equity instrument. We had revised till the basic measurement and everything. From this revision lecture I'm starting with 7th point, reclassification of financial asset and financial liability. Now what is the meaning of the point reclassification? First let's talk about financial assets. Acha, do you remember for financial asset we had which methods? We had ACM, we had FVT OCI R, we had FVTPL, we had FVT OCI NR. These methods were there. Acha, which method do we choose? Is it the choice of the company? The answer is no. It depends on the outcome of two tests, business model test and CCFC test. So now, if your business model previously suggested ACM, but now the company has changed the business model, so can we change the method as well for the financial assets? The answer is yes. That is known as reclassification. So basically, reclassification means change in the accounting method. So basically, previously you were following ACM, now you might have to follow FVT OCI R, or previously you were following ACM, now you have to follow FVTPL. Okay, so do remember this reclassification happens only when there is a change in the business model, and if this change is to be done, it is to be done at the beginning of the year. Okay, out of these 4 cases you can reclassify between any cases, but in one method reclassification not permitted, and that is FVT OCI NR. Because in case you remember, we choose FVT OCI NR only when there is only when we wanted to choose an irrevocable option. Whenever you choose FVT OCI NR in itself is an irrevocable option. That is why if you choose this method, you cannot change the method anytime. Okay, then the basic stuff is given. If you are going from the old method to new method, then how will the accounting be done? Just give it a read. Okay, from exam point of view, you should just know that this is possible and just give it a read. Okay, that is fine. In the revision lecture, of course, my focus is mainly on those parts which are more relevant from exam point of view. Anyways, what about financial liability? Reclassification in case of financial liability is not permitted. Why? Arey baba, in case of financial liability already we have only one method, ACM. In few cases we might use FVTPL, but in most of the cases we have only ACM, right? So if you are running alone in the race, then how can we reclassify, right? Oh yeah, oh yes sir. Chalo. So this was reclassification. Now the next point is going to be derecognition. Okay, derecognition of financial asset. Now let's start discussion about the same here. Now first of all, let's understand what is the meaning of derecognition. Derecognition simply means removing anything out of your books. That is known as derecognition. So when will a financial asset be removed out of your books? So there are 2 types of derecognition discussed here. One is full derecognition and one is partial derecognition. Okay, in full derecognition, it is very simple. So let's suppose, for example, I have a financial asset in the name of investment in debentures. Tell me, when will I remove this investment in debenture out of my books? In 2 circumstances. First, when the life is over. What is the meaning of life is over? For example, you were supposed to receive interest, you have received all the interest payments. You were supposed to receive principal, you have received all the principal repayments. So when you have received whatever was promised to you, life is over. When the life is over, financial asset will be nullified from my books. Okay. Second instance can be sale. When you sell this financial asset, at that time also, you can derecognize the financial asset. So these are the 2 instances where you will derecognize the financial asset. Okay. Then this was a full derecognition. That means full derecognition can happen only when your contractual cash flows are fully received from financial asset, or you have transferred or sold the financial asset. Simple. And whenever you derecognize the financial asset, if you are selling it, whatever profit loss is there, it is a realized profit loss. Transfer it to P and L. Is this clear to everyone? Good job. Then we discuss about partial derecognition. Okay, in partial derecognition there are multiple cases, but as I already told you while I was teaching, focus on that one question of C limited. Don't worry, I will revise you everything once at least. Okay, now what is the meaning of partial derecognition? So basically under partial derecognition there are three definitions given. How many definitions? Three definition. If you fall under the three definition, then you will call it a partial derecognition. So first let's discuss the three definitions and then I will teach you the accounting as well. Okay, now what was the first definition point talking about? First of all, let's try to understand in any financial asset. Let's for example say in case of we have investment in debentures. So is it a financial asset? Yes. How many cash flows are there in debentures? 2. Interest and principal. Okay. Now what the three definition says is, first of all, please remember it is a partial derecognition. Acha. The first definition says is the part transferred comprises of specifically identified cash flows. Now in case of investment in debentures there are two specific cash flows. Let's say out of the two cash flows I have transferred any one cash flow. Remember sale of, we sold only the interest portion of the financial asset, or else we sold only the principal portion of the financial asset, right? So that can be known as the partial derecognition. I also explained to you with the help of a chart how this whole thing happens. Okay, not going into the depth as of now because it is a revision lecture. Anyways, so the first definition is when you transfer any one out of the two specific cash flows. Okay. Second, part transferred comprises of fully proportionate share of the cash flows. That means you are transferring both the cash flows but not 100%. You are transferring some proportion of both the cash flows. Let's say for example you transfer 40% of both interest and principal, or you transfer 30% of interest and 35% of principal. So that time you will fall under definition point number 2. Or else third part transferred comprises of fully proportionate share of specifically identified cash flows. This means you are transferring any one cash flow out of the two, and also in that one cash flow you are not transferring it fully, you are transferring some proportion of it, right? For example, you are selling 40% of interest portion, or else you are selling 30% of principal portion. Okay, so if you are falling under any of the three definition, then you will fall under partial derecognition, case number A. So in partial also there are three cases, case A, case B, case C. So if you fall under three definitions, you are falling under case number A. So how is the accounting done in case number A? First let's discuss and then we will also revise with the help of one question. So in case number A, what we will say? First of all, because you are derecognizing only a part of the financial asset, you will derecognize that part at carrying amount. Okay, and because you're selling something, you will receive some money. Okay, so whatever is the difference between the selling price and the carrying amount of the part derecognized will be transferred to profit and loss. So because we are not selling the full asset, there will be some part retained. If there is some portion which is retained, that retained portion will continue to appear in the balance sheet at carrying amount. I will prove this with the help of an example, so don't worry about it. Acha. Now one more thing. While I was giving you some examples of the three definitions, I also told you if the three definitions have these words. Let's say for example I was saying sale of 40% interest, or sale of 100% interest, or sale of 30% principal, then we were falling under partial derecognition. Okay, but when I say sale of first 2 years of interest, sale of last 2 years of interest, sale of first 20%, sale of last 40%, whenever you see the words first and last, always remember we will not fall under the three definitions. Remember I gave you the logic in the class also. Okay, so whenever you see the words first and last, you will not fall under the three definitions. In that case, accounting of partial derecognition does not apply. In that case, we will do the accounting of full derecognition. So what is the meaning of full derecognition? That means even if you are selling a part of the asset, still you will derecognize the full financial asset. You will derecognize the full financial asset. At what value? At carrying amount. Then whatever part you have retained, you will re-record that at fair value. See, for example, I have sold only 70% of the asset, but still I will remove 100% of the financial asset. Okay, then I will re-record the part retained, but the difference here will be the retained part is re-recorded here at fair value. Okay, of course you will also record the proceeds which you received from selling the financial asset, and the difference whatever is there, it will be transferred to profit and loss. Don't worry, I will justify this with the help of an example as well. Okay, so what is the difference between case 1 and case 2? The only difference is in case 1 we apply the accounting of partial derecognition, and here the retained part continues to appear at carrying amount only. In case B, when there is words first and last, we apply the accounting of full derecognition, and here the retained part is re-recorded again at fair value instead of carrying amount. Okay, so what is case C here? Remember, case C is nothing but whenever there is service fees also involved. So there is case A along with service fees or case B along with service fees. In that case, you will fall under case C. Anyways, now we had one question for this discussion, and that was the question of C limited. Remember the discussion of this question. Whenever you are revising derecognition, do revise this question as well. Okay, so I'll just give an overview revision of the same. What was there? We had a financial asset worth 10 lakhs. Okay, EIR was given 18%. Today's fair value is this much. Okay, now we are selling portion of the financial asset, right? So it is given other way around. We sold the principal and interest, everything we sold after retaining 10% principal and 4% interest. Okay, so can you see any word like first 10%, last 10%? The answer is no. So can I say it is falling under case number A, where you are selling some portion of both the cash flows, selling some portion of principal, selling some portion of interest, right? Okay, sir, got it. So it is a case of partial derecognition, case A. What is to be done, sir? Simple. Whatever part you are selling, you will remove that part at carrying amount. And you will record the proceeds received. Difference will be transferred to profit and loss. And the retained part will continue to appear at carrying amount only. Okay. Also, there is a 2% service fees involved here. That is 65,160. So it is mentioned that the interest component includes whatever the amount of interest is given. It already includes the service fees. Okay. What is the concept of service fees, sir? Basically, when you sell the part to some third party, the money will initially be received by the main party and then it will be transferred to third party. So he will charge a service fees like a commission basically. Okay. So now how is the accounting to be done? See, it is very simple. Have a look here. One second. Yeah. So let's say we have the carrying amount of the full asset, 10 lakhs. But the issue is we are not selling the full financial asset. We are only selling that particular part. Okay. We are only selling the particular part. So ideally, I need the bifurcation of carrying amount. What is the carrying amount of the part which is derecognized and what is the carrying amount of the part which is retained? I don't have this bifurcation. How do I bifurcate? I have the fair value of both the parts. So I will bifurcate in the ratio of fair value. So my next step is finding the fair value of the part retained and the part derecognized. The fair value of the part retained is given in the question. If you read the question, you will find the fair value of the part retained. So if total fair value is this much, and retained part fair value is this much, you can find the fair value of part derecognized by using the balancing figure. Okay, but why am I finding the fair value? The logic is simple. In the ratio of fair value, I will bifurcate the carrying amount. So you bifurcated, you got the carrying amount. Now what to do? This is the part which you have sold. So this will go out. So you will say to financial asset 825,468. Okay, now you have sold it for 9,90,000. So you will record the cash bank received. Difference will be transferred to profit and loss. And as mentioned by me, the retained part will continue to appear at carrying amount. So the retained part carrying amount was this much. So it will continue to appear this much only. Also, I gave the bifurcation of during this retained part, what is the amount of principal, interest and service fees. So that bifurcation you can get by bifurcating the ratio of fair value. Okay. So this was the normal question which you just did. But in class, do you remember I also gave another case? Assume in the above question, there was words first and last. If there was words first or words last, then it will not fall under the 3 definition. Then we will say that you will have to apply the accounting of full derecognition. The only difference between above example and this example will be that you will derecognize the full financial asset and you will re-record the retained part again at fair value. Difference will be any which ways transferred to profit and loss only. So this was the case created by me, not there in module. Okay, do remember that part. Anyways, done with this. Yes, perfect. So this was the derecognition of financial asset, the main portion. Okay. Now there is one more concept which we have to discuss under derecognition, and that is some special cases I mentioned. Let's discuss them. First special case is bill discounting. What is the meaning of bill discounting? Let's say I have a bill where I'm going to receive a payment after 3 months. Okay, so I go to the bank and tell me that you keep this bill and give me some money. Okay, so bank takes the bill and discounts them. For example, the bill is worth 10 lakhs, but bank will only give you 9 lakhs. Why? Because bank is charging 1%, 1 lakh rupees interest or commission, whatever you can say. Now, ideally what we used to do when we were discounting the bill, we used to remove the bill from our books. But what India says, when you are discounting any bill from bank, the risk and reward are not yet transferred to the bank. Why? Because if bank after 3 months is not able to recover the money from the party of bills receivable, it will recover the money from you. It will recover the money from you. right? So that means the risk and reward have not been transferred yet. Okay, so in that case, what India says is you should not de-recognize the financial asset and record the proceeds. Instead, it is just like taking a loan against the mortgage of bills receivable. So you will record cashback to financial liability. You will not de-recognize the financial asset on day one. Once the 3-month period is over, once bank receives the money from the party, that time you can reverse the loan and you can de-recognize the financial asset. Okay, this was one special case which I discussed with you, bill discounting. Similarly, we have 3 other cases. Factoring. Under factoring, we have 3 cases: factoring with full recourse, factoring without recourse, or factoring with partial recourse. Now, what is the meaning of this? Factoring with full recourse simply means that what is the meaning of factoring first? Just like we sell bills receivable to bank and receive money on day one, similarly, we sell debtors to a third party and receive the money on day one, right? So let's say, for example, I have so many debtors, but they are going to repay me after 6 to 9 months. So I will sell my debtors to a third party, to a factor. He will give me the proceeds on day one itself. Now, factoring agreements can be of 3 types. One is factoring with full recourse. What is the meaning of full recourse? When you sell the debtors to the factor, at that time, the full risk is retained by the company, full recourse. That means when you are selling the debtor, you are not selling the risk. What is the meaning of not selling the risk? If the factor is not able to recover the money from debtors, it will recover the money from the company. Simple, right? So risk is retained by the company in this case. So in this case, when the risk is retained by the company, you should not de-recognize the debtors on day one. Whatever proceeds you receive, you should record it as a financial liability. Simple, clear? Okay. Second case is factoring without recourse. Without recourse means you have sold the debtors to the factor. Now the company's risk is over. If factor is able to recover the money from debtors, very good. If this factor is not able to recover the money from debtors, is the loss of the factor himself. Company will not do anything in this case, right? That is known as factoring without recourse. So what is to be done in this case? In this case, whatever proceeds you receive, you will record it and you will remove the financial asset. Why? Because risk and reward have been transferred. Okay, done. And difference will go to profit and loss. Now, third and the important case, from exam point of view, this is important in de-recognition, and that is factoring with partial recourse. Factoring with partial recourse. What is partial recourse? Partial recourse means you have sold the debtors, but you have retained some partial risk. For example, in case you remember, we discussed one example for this as well. Let's say, for example, I have a debtors worth 5 lakhs. I sold it for 4,50,000, but I retained the risk up to 20,000. That means if the factor suffers a loss up to 20,000, I will reimburse him. But if a factor suffers a loss of more than 20,000, then it is a loss of the factor. Up to 20,000, we will reimburse the factor. That means we have retained the risk only up to 20,000. That is known as factoring with partial recourse. Now, how is the accounting to be done in this case? So I will take this example as a base. So let's say debtors were worth 5 lakhs and factor paid me 4,50,000 for that debtors. Risk I retained for 20,000 and the fair value of this risk is 5,000 respectively. And there are 3 cases given. Let's discuss the accounting on day one. First of all, in partial recourse, you will de-recognize the full financial asset. So whatever proceeds you received, you will record it. You will remove the financial asset, record the difference in profit and loss. But can I say you retained some risk? So for the retained risk part, you will record one asset and one liability, and that is continuing involvement in asset account debit to associate liability. Sir, why an asset and why a liability? Because you retained the risk, so liability. But why asset, sir? Because the risk will arise only when debtors are not able to pay. That means the first liability is of the debtors to make the payment to factor. If debtors do not pay, then only I will have to pay. That means I have an asset also now. Why? Because primarily my asset is responsible to make the payment. Therefore, one asset, one liability. Okay, so I recorded it at 20,000, 20,000. Then whatever fair value is given, let's say the fair value is given of 5,000. So for that 5,000 fair value, you will record P&L to associate liability. What is the meaning of this 5,000? It simply means that if you have retained a risk of 20,000, on day one, what do you feel? How much payment you will have to make under this risk? So on day one, we feel that my loss is going to be 5,000. So I recorded at 5,000 P&L to associate liability. Now you will say, sir, your associate liability becomes 25,000, but you retained a risk of only 5,000. No? Then how come you are recording 25,000? Just remember that ideally we are not recording 25,000. Ideally, against the initial 20,000, we recorded an asset also, right? Then we recorded extra 5,000. So effectively in net, we are recording a net liability of only 5,000. Okay, Just remember that part. Also, then I had given 3 cases. Case way, I had taken this example one step ahead, right? In module only day 1 accounting is discussed. Okay. Also in day 1 I say na P&L to associate liability. Remember I had given you a note in as per ICAI. They are not recording the full difference on in profit and loss on day 1. They are saying that they want to book this over the period. So they transfer this as well to CIA, continuing involvement in asset account debit. That is as per ICAI, but ideally it should be profit and loss. Anyways, like in exam do as per ICAI only. Okay. Then there were 3 cases. These 3 cases are not there in module. I have discussed this case. What are the 3 cases? What if debtors pays only 4,90,000? Can I say in that case I will have to make the balance 10,000 payment because risk up to 20,000 I was ready to bear. So whatever asset liability is there, first reverse it. Whatever payment you have to make, because debtors only paid 4,90,000, now it is the company's duty to make the payment of 10,000, right? So it will make the payment of 10,000 and record the balancing figure in profit and loss. Similarly, in case number B, if the debtors paid full amount, no liability will arise in my case. In case number C, debtors paid only 4,20,000. The loss of factor is 80,000, but I will only reverse him. I will only reimburse him 20,000. Do remember that part. Not going into detail for this entries because not relevant from exam point of view. After this, what you should do is, as soon as you read this provision of factoring, you have to discuss illustration. You have to revise illustration of 124A, B, and C. Not LDR, but exactly similar to what we discussed in my example. So not wasting time in revising it again. Illustration 124A, B, and C you can revise. It is a straightforward question. Okay. Acha, do remember when you are studying D recognition, many students face very much discomfort with this topic. Let me tell you, it only has 2 things. One is the question of C limited that I already told you. Bifurcate the carrying amount in the fair value ratio and derecognize. Simple. And second thing is factoring. That's it. Nothing else. So even if you are comfortable with these 2 parts, it is sufficient for me. Okay, do remember that part. So don't create any havoc, right? Oh my god, it is difficult, it is tricky. No, it is very easy. It is very easy. Oh yeah. Chalo, done. So this was derecognition. Now I guess we can proceed with the next point, and that is what we discussed above was derecognition of financial asset. Now what we are going to discuss is derecognition of financial liability. When do you derecognize a financial liability? When you have made the payment. For example, there is a creditor. When will I derecognize the creditor? When I made the payment to a creditor. So it is said that derecognize the financial liability from balance sheet when it is extinguished. That is when obligation specified in the contract is discharged or cancelled or expired. First thing. So in that case, you will remove the financial liability. Acha. In financial liability, there is also a concept where you will not remove the full financial liability, but there are some modifications in the original financial liability. So for modification, for these 3 pointers, we will refer directly to the next point. We will go on to the next point, and that is modification. Okay. So nothing major in this point as of now. Okay. Now let's discuss about modification. Now what is the meaning of modification? First, let's try to understand that part. Let's say for example, this is AK Limited. This is Chetan Limited. I took a loan from Chetan. So for me, it is a financial liability. Now let's assume I made repayment for year 1, repayment for year 2, repayment for year 3. In 4th year, I got committed. When you get committed with a girlfriend or boyfriend, in that case, you don't have funds. You only have funds to give gifts to girlfriend, boyfriend. Now I don't have funds to make the repayment. So when I don't make the repayment, and I request my dear Chetan that I'm really very sorry, I won't be able to make the repayment for this year. So please change the repayment schedule for me. So either Chetan will help me by reducing the interest rate, or he will help me by changing the tenure. That means your original terms are not holding true now because I have made a default. I have made a repayment default, right? So in that case, we will apply modification accounting. What to apply? Modification accounting. So modification accounting is discussed from both the cases. From the case of borrower, for whom it is a financial liability, and from the case of lender also, for whom it is a financial asset. So first we will discuss about modification accounting from the case of borrower, for whom it is a financial liability. Now how does the borrower account for this? So first of all, in modification accounting also I have given you specific steps. Okay, what is going to be my step number 1? First you will identify whether this modification is substantial or not. For example, let's say, do you remember what is the meaning of this? Let's say for example, Kishan is there. So Kishan cheated with his girlfriend. So you will have to identify the quantum of cheating, how serious it is. So if it is a small cheating, Kishan just kissed a random boy, So girlfriend is fine, okay. If you're kissing a boy, it's okay. Okay. So that in that case, we will say the crime by Kishan is not very substantial. But if Kishan committed a bigger crime, can I say it can lead to breakup? Similarly, in case of loan, you will have to check how is the modification, whether it is substantial or it is a small minor modification. Okay. How do we check it, sir? For this, you have to compute two amounts. First, carrying amount of old financial liability on date of modification less present value of revised future cash flows, including transaction cost outflow at old DIR, divided by the carrying amount again. So, whenever you are doing the modification, you want the carrying amount as on that date. Compare that with the revised future cash flows present value at old DIR. When you compute revised future cash flows, also don't forget to add a transaction cost, okay, and discount them at old DIR and divide again by the carrying amount. Don't worry, I will discuss this all things with the question also. Acha. Then you will get, when you solve this, you will get something in percentage. Whatever sign you get, ignore it. Now, if this percentage, the answer you get, the base is 10%, okay. If you get the answer at less than 10%, we will say modification is not substantial. But if we get the answer as more than or equal to 10%, we will say modification is substantial. Accounting in both these cases is little different. If the modification not substantial, tell me one thing, not substantial na? So should I do breakup? No. So in this case also, if the modification is not substantial, I'll give you two options. Chalo. Not substantial na? So two options you have. Either you can do small adjustments in the old loan itself, or you can say, sir, modification has happened, so I will remove the old financial liability and record the new financial liability. Tell me. Two options. Either make small adjustment in the old financial liability. Second option, remove the old financial liability and record the new financial liability. So, of course, when the modification not substantial, can I say it is better to adjust in the old financial liability itself because it is a minor modification, na? Okay. So here also it says the same thing. When the modification is not substantial, whatever adjustment you are doing, do it in the old loan itself. How do you do the adjustment? Simple. Whatever transaction cost you incurred in the modification, adjust it from the old financial liability. Now, because your old financial liability's carrying amount will change, you will have to compute a new EIR in this case. How to compute a new EIR? And why to compute a new EIR? How to compute it? Apply interpolation. Why to compute it? Because of two reasons. Because of transaction cost to adjust from carrying amount. So the carrying amount changes, LAT won't match. Second thing, even your repayment schedule has changed. So you will require a new EIR. Okay. So if the modification not substantial, further steps are going to be adjust the TC from old financial liability, compute a new EIR, and then prepare the LAT after modification. Do remember, when you are preparing the LAT, under opening, take the carrying amount of old financial liability after deducting the transaction cost on modification. In EIR, take the new EIR which you just computed, then repayment, then closing, your LAT will tally. Okay. Acha, what if the modification turns out to be substantial? In that case, if there is a major loss, it leads to breakup. Breakup means you will de-recognize the old financial liability at carrying amount. You will record the new financial liability. How to find the values, I will teach you, don't worry. Difference will be transferred to profit and loss. Whatever transaction cost is there, it is directly transferred to profit and loss. And then prepare the LAT after modification. Now I just gave you an overview of the steps. Of course, just by reading the steps, you don't understand anything. So how about discussing some example? Okay. So in our textbook, we have certain examples in the form of solved examples, if you know, right? So let's say we come on towards example number 2. Okay. So see what was given here. Now I will teach you how to do the accounting for modification. Okay. Please be patient and listen to me very carefully. On 1st Jan 10, XYZ issues 10-year bonds for 10 lakhs. Interest coupon is 10%. Okay. And redeemable after 10 years. Okay. At 10 lakhs only. So there is no interest, no discount. No premium, no discount. And also there are no transaction cost on day one. So, acha, do remember, when you only have coupon, but you have no premium, no discount and no transaction cost, in that case your coupon and EIR turns out to be the same. Okay. Anyways, on 1st January 15, that is after 5 years, there was a modification which was happening. How was the modification happening? It says that no further interest payments are required. Bonds are redeemed on original date only, but for 16 lakhs. Previously you were going to redeem at par. Now you will redeem at premium. Okay. And there is transaction cost of 50,000. Now how to account for this modification? Do remember, in modification questions, don't directly jump on towards the modification. every modification question, remember I told you bifurcate into two parts. The first part is going to be the accounting which was happening before modification, and then the accounting of modification will be done. Let's say for example, this was the loan, 10 years loan, right? So can I say modification happened after 5 years? So first prepare the LAT till 5 years. Okay, so how do we do it? First do the normal accounting. What are the normal steps? Step number 1, cash flows. Step number 2, fair value. Step number 3, EIR. Step number 4, LAT. In this question, there is no CFI, no relation, no level 1 input. So you can assume the fair value. Okay, so directly assume the fair value to be same as face value or transaction price, you can say. EIR, LAT is there. You will prepare the LAT only up to 5 years. Why? Because this is the date when the modification is happening. Prepare the LAT, stop here. So that is in modification types of question. First do the normal accounting. Done, sir. Then we will jump on towards the modification accounting. How to do the modification accounting, sir? First step number was, first check whether modification is substantial or not. How do we check it, sir? We need two values majorly. Carrying amount of old financial liability on date of modification. How do we get this? We get this from the LAT which we prepared till modification date, 10 lakhs. Second, what we need? Present value of revised future cash outflows, including transaction cost outflow at old EIR. What is the meaning of this? See, when you read this, the terms after modification, these are the revised future cash flows. So as per the revised future cash flows, no interest payment required. Principal will be done at the end of 19 only, but at 16 lakhs. Also there is some transaction cost on modification, right? So how do we do it now? So these revised cash flows, you have to find the present value. How do I find it? Just imagine we are standing on the date of modification and just recall what all things you have to pay during this 5 years. Why 5 years? Because the pending duration is 5 years. During this 5 years, no coupon is to be paid. Only principal payment is to be made after the end of 5th year. And on day 1, you are also incurring transaction cost. So these are all outflows. So just add all the outflows. Because TC is incurred on day 1, don't apply any discounting factor or apply the factor of 1. Because incurred on day 1, and this you are incurring after 5 years from the date of modification, right? So apply the discounting factor of 5th year at the rate 10%. So you will get this present value. Okay, acha, now one doubt might arise, why we are adding transaction cost? In case of FL, normally we deduct it, na? Why we are adding in this case? Do remember here our motive is not to find the fair value. I have given the logics here, okay, you can read them, but just revising you that our motive is not to find the fair value. Our motive is to find the present value of future cash outflows. When we are computing this, principal is also an outflow for us, this is also an outflow for us, so add both of them. Okay, logics I have given here. So just remember, in case of transaction cost of financial liability, modification, under modification, this is the only case where we are adding transaction cost. In all other cases of FL, we will only reduce it. Okay, if you want to remember, you can remember it this way. Anyways, so you get the value at this much. When you compute the percentage, you get as 4.35%. Can I say it is less than 10%? So modification not substantial. If it is not substantial, what should I do? Should I remove the old and record the new, or should I make the adjustments in the old only? So I will make the adjustments in the old financial liability only. How to make the adjustments? First, whatever transaction cost is there, you will adjust in the old financial liability. So I adjusted it. As soon as you adjust this, your carrying amount gets revised. Okay. Then you have to find the new EIR. Why new EIR is required? The reason being, because you have adjusted that transaction cost from carrying amount, and also a repayment schedule has changed. So new EIR will be required. Followed interpolation, found out the new EIR. Then prepare the LAT after modification. Before modification, prepared for the first 5 years. After modification, you will prepare for the remaining 5 years. Okay, in opening, take the revised carrying amount. Interest, take the new EIR. Repayment and closing, you will take as per the revised terms. It will match. Clear with this? This was example number 2. We also have one more example, example number 1, which was very similar to example number 2. The only difference is here the term is extended. In previous question, the term was not extended. Here the term is also extended. Okay, interest payments are not waived off, they are reduced to 5%. Okay, the bonds are redeemable at 15 lakhs and there is a TC of 1 lakh. TC means transaction cost. Okay, so the initial part of the question is same, only the modified part is different. How do we do this? Again, same thing will happen. We will do first the normal accounting till the date of modification. It remains the same. Then we will do the modification accounting. Okay, in this first step is to check whether it is substantial or not. The procedure remains the same. Okay, now you can find it on your own. When you check this, you get the answer as 11.32%. Now, can I say it is exceeding 10%? So the modification is substantial. when the modification is substantial, what to do now? So it is a big fight, it leads to breakup. That means you will have to remove the old financial liability and recognize the new financial liability. Now, how, at what value do we remove the old financial liability? It get removed at carrying amount. Do remember, whenever any asset or liability goes out of your books, it goes out at carrying amount. Okay, second thing, we will have to record the new financial liability. The new financial liability you will record at fair value. Okay, you will record at fair value. So what is the fair value? Please don't confuse this amount with fair value. This is not the fair value, Baba. This amount we computed only to check whether the modification is substantial or not. So what is fair value? Fair value is nothing but present value of revised future cash flows at new EIR. When we were finding whether the modification is substantial or not, we were using the old EIR. To find the fair value, we use the new EIR. Okay, and also the transaction cost treatment is different in this case. So how do we find? We already have the future cash flows, revised future cash flows, discount them at the new EIR. Sir, how do we get the new EIR? It is given in the question at 11%. If you see, it is given that new EIR is 11%. Okay, so we discount them at 11%, we get this value, difference transfer to profit and loss. Sir, what about the 1 lakh transaction cost which was there in this question? You will have to adjust and transfer it to profit and loss directly. The only case where TC is getting transferred to profit and loss. Sir, why profit and loss? Just one assumption you can take is that this TC was incurred for the old financial liability. So when the old financial liability is out of your books, you should also remove that transaction cost out of your books. Simple. This is one of the assumptions which you can take. There are multiple reasons for this, but giving you the simpler one. Okay, then you will prepare step number 4, LAT. So what are the steps? Summarization. Step number 1, check substantial or not. If it is substantial, remove the old FL, record the new FL. Then transaction cost will be transferred to profit and loss, and the last step is LAT after modification. Okay, please remember, my motive here is to just recall you the steps and just revise everything for you. My question revision is not a replacement of a writing practice. Of course, you will not gain confidence just by referring to my lecture and referring to this question when I'm revising it. Of course, you will recall things, but if you want to gain the optimum level of confidence, you should also focus on self-writing practice. That is the key. That is going to be the key. Please do remember that part. Okay. Anyways, chalo. Now, for borrower, we solved 2 examples. There was one big question also in case of modification. Let's check that question out as well. Okay. That is illustration number 124. Okay. One sec. Yes. Now we will revise this illustration 124. It is also question of modification from the point of view of borrower. Okay, let's quickly revise this question. What was there? Do remember, in class also I mentioned, do write and practice this question. It is very important. Okay, chalo, let's continue. Wheel Company Limited. One second. So it was given this Wheel Company Limited borrowed 50 CR from a bank. So we are a borrower. Original terms are given, interest coupon is given, repayment of principal in 5 equal installments. My God, do remember, I already told you, whenever principal repayment happen in installments, for step number 1 cash flows, you will also have to prepare a working note number 1 cash flow table. Okay, then payment of interest annually, upfront fees. This is the transaction cost, but not on modification. This is the TC on day 1. This much. See, just remember, when your coupon is there, you don't have discount, you don't have premium, but you have TC. So your EIR and coupon won't match. It will be different because in EIR you want to amortize the TC also. Anyways, so it is given directly. So 11% is your coupon, 11.5 is your EIR. Acha, if this was not there, then coupon and EIR would have been the same. Anyways, okay, sir. Then after 2 years, there was some modification which was happening. Let's talk about the modification later on. First, how to do it. As I said, divide the question into 2 parts. One is before modification, one is after modification, right? How do we do the before modification part? So first step is going to be cash flows. Because even principal is getting repaid, you will have to prepare a cash flow table. So I prepared the cash flow table. I repaid the principal in 5 equal installments, and for interest I took whatever accrued was there. Okay, do remember, when you're preparing cash flow table, columns are same as LAT, but in opening you write face value, in interest you write coupon. Okay, we got this, sir. Then step number 2 is fair value of FL. I gave you a shortcut. In this question there is no relation, no CFI, no level 1 input. So you can directly assume the fair value to be TP less TC. Okay, I assumed it. I got the fair value answer. Then step number 3 is EIR. It is given. Step number 4 is LAT. Okay, LAT you will prepare only up to the date of modification. Barabar. So in this case, You will prepare up to the date of modification. That means you will prepare only for the first 2 years. Okay. Now, for the first year, we prepared the LAT, done. For the second year, do remember that this was the date. This was the date when the modification was happening, right? So if you are doing the modification on this date, definitely you might not have the money to make the repayment of this date, right? So that is what is assumed, that you don't have the money to repay what is the installment on the date of modification. But in question, one thing is mentioned: before approaching the bank, wheel company made the interest payment on 31st December 12. Do remember, every year we are paying two payments. One is principal, one is interest. So it is said that when you are approaching the bank for modification, you don't have the money to make the principal repayment, but you only have the money to make the interest repayment. So you only made the interest repayment in the question. Okay. Now, if you are making the interest repayment, then this is the closing balance of your loan. Also, I made you write one thing, that what is the outstanding principal's face value. For example, your loan amount was 50 lakhs. You paid the first principal, you paid the first interest. In the second year, you only paid the interest. What is your outstanding principal amount's face value at the end of year 2? It is 40 CR. So this is the fair value of the loan outstanding, and this is nothing but the face value of the loan outstanding. Why am I writing this? It will be useful for you. Is this clear to everyone? Yes. Now we will do the modification accounting. Okay, so this was the before modification accounting. Okay, now under modification, just remember the steps. What was step number 1? So step number 1 was to check whether it is substantial or not. So check it. First we need carrying amount of old financial liability. We already have it through LAT. Then we need present value of revised future cash flows, including transaction cost at old DIR. How do we find this, sir? Read the question now. As per the revised terms, interest rate will be 15%. Repayment of outstanding principal will happen in 10 equal installments. My God, even in the repayment of principal on modification, it is happening in installments, right? That is why I've told you to found the outstanding principal amount, because when you are making the repayment of principal in installments in modification, you will only consider the outstanding principal. Na? What principal you have paid, you will not make the payment again. Na? Okay, then payment of interest on annual basis. Now, so in this case, you will have to, again, for this present value of revised future cash flows, you will have to prepare the cash flow table again for the revised future cash flows, right? So I prepared a cash flow again. Whatever opening was there, interest I took, then I found the repayment each year. Okay, and there is no TC, by the way, on modification. Okay, so whatever cash flows you get, you will discount them at the old year. You will get this value: 4512 22,791. Sorry, 4515 22,791. So you can now check whether it is substantial or not. You already had this. You will write the revised future cash flows, divide by this amount, you will get some answer. Okay, do remember, before proceeding further, what are the two most important points in this question? The two most important points are only that preparing the cash flow table in before modification part as well, and during the modification part as well. This question seems to be lengthy only because of this part. Only because of this part. Otherwise it is simple. Okay, so we got the modification as substantial. No worries, sir. Now, if it is substantial, what to do? Remove the old, record the new. So we will remove the old financial liability, record a new financial liability. Now, how to record the new financial liability? See, under the modified terms, there was no premium, there was no discount, there was no transaction cost. So there is a hint that your coupon and EIR is same. Your revised coupon and the EIR is going to be same, because no premium, no discount, no TC. And when the coupon and EIR are same, you know, I'll give you one shortcut. When these two are same, na, when coupon and EIR is same, your face value and fair value will be same. If you want, you can compute. You can discount the revised cash flow at new EIR, but it will come at 40 CR only. Why? Because when coupon EIR is same, face value, fair value is same. These are the small shortcuts which I have given you so that you save some time in exam. Do remember that part. Okay, so we removed the old, we recorded the new. Then whatever transaction cost is there, it will be transferred to profit and loss. It, in this case, it was nil. And then just prepare the LAT after modification. It was only asked to prepare for another 1 year, so we prepared it. Okay, that's it. Now entries were also asked. How to pass the entries? Passing entries is a piece of cake. Why? Just refer LAT and pass the general entries. You have prepared LAT, just refer it, pass entries. For example, this was the old LAT. Record the opening first, then record interest, then make the repayment. Next year, record interest, make the repayment. Okay, then modification happened, pass the modification entry. Then after that, record the interest, make the repayment. So just refer LAT and pass the entries. Okay, so this is what was asked question, which can consume a lot of time in exam if you have not practiced at home. So do practice that part at home as well. So this was done. Okay, this was illustration number 124, and with this we are done with the modification from the point of view of borrower. Now we will do the modification from the point of view of lender. From the point of view of lender, well, who is lender? Lender means the person who is investing or giving the money. For him it is a financial asset. So for lender, the accounting is not that complicated, like first checking substantial or not and then doing the accounting. No, for lender a straightforward accounting is given. What is the accounting, sir? Do remember, in case of financial asset, your EIR does not change. Okay, so what are the steps? First step is have to find the carrying amount of old financial asset. Second step is compute the present value of revised future cash flows at old EIR. Okay, compute the present value of revised future cash flow at old EIR. Revised cash flows information will be given. Okay, compute that. Then step 3, pass the journal entry for modification. How to pass it I will teach you while doing the question. And then step 4, prepare the LET. So how to remember the steps? The step 1 and 2, can I say the step 1 and 2 resembles the step 1 of borrower? In case of borrower, remember we used to find carrying amount of old financial liability and present value of revised FCF at old EIR for borrower. Same is the case with lender. So borrower's step number 1 becomes lender's step number 1 and 2. Here we find in step 1 carrying amount of old financial asset. In step 2 we find the present value of revised FCF at old EIR only. Okay, then pass entry and then prepare the LAT. Okay, this is the basic steps for modification in case of lender. Now how to do it, sir? For this we will refer 2-3 questions we have. We will refer all of them. One is illustration number 123. If you read 123 on the face of it, it seems to be a big question of more than a page, right? But it is a very good question. Always remember, there are 2 ways of referring to a question. If you see it is very big and get scared, the second way of seeing it is that whenever a question is big, a lot of information will be given in the question itself, so your time will be saved. Okay, now how to solve it? So first of all, here we are giving a loan to employees. Okay, so we are a lender, we gave a loan to the employees. Oh my god, we gave the loan to the employees. That means relation is there. Oh yeah, relation of employer-employee is also there. Okay, so we gave the loan of 10 lakhs. Interest was like on full 10 lakhs. A flat rate was not there. On the first 4 lakhs, we will charge 4%. On the next 6 lakhs, we will charge 7%. Starting date is this much. Tenure is 5 years. Okay. Principal will be paid in 5 equal installments. My god. Again, the principal is to be paid in installments. In step number 1, you will have to prepare a working note number 1. Okay. And whenever you pay the principal back, which principal will get repaid first? The 4% principal or the 7% principal? So whenever you are repaying, it clarifies that you will repay this first. This 6 lakhs will be first repaid. The higher rate of interest will be first repaid, and then you will repay from this. Anyways, chalo. Then interest accrues on annual basis. X remains in service to the loan. Okay. Comparable loan 12%, that is the EIR. Why is the EIR and coupon different? Because relationship is there. Because you are giving a loan to employee, you are charging him less coupon, but market rate is may be different. Okay. Do you remember, whenever there is a relationship, you will find the fair value, and whatever difference come, where will it be transferred? Perfect answer, it will be transferred to prepaid employee benefit expense. Very good. Okay. Now some table is given. What is this table? You know what is this? What did I say? Because you are repaying in installments, you have to prepare a working note number 1. Luckily, that working note is given in the question. In step number 1, prepare a cash flow table. That is already given. I said now, when the question is big, given information is more. So how much of the cash flow each year, it is given in the question. Okay. Then some modification happens. How does the modification happen? At the end of second year, we had to repay 2 lakhs plus the interest, but the employee prepays extra 2 lakhs. So instead of making 2 lakhs principal repayment, he makes 4 lakhs principal repayment. So he prepays 2 extra lakhs. Okay. Reducing the outstanding principal as on that date to okay. Then the revised cash flow are also given. Because you are repaying it early, what are the revised cash flows? See, as per the revised terms, you repaid extra 2 lakhs year itself. So only this much is pending after modification. Now how to solve it? Okay, let's try to discuss. First, again, for this modification also, divide the question into 2 parts. One is before modification, one is after modification. First, what will happen before modification? Step number 1, find the cash flows. already given in the question. Step number 2, find the fair value. Okay, EIR is given, you will find the fair value. Compute. Why compute? Because there is a relation. Because you compute the fair value, there will be a difference between TP and fair value. Where will the difference get transferred? It will get transferred to prepaid employee benefit expense, and you will write off it over a period of 5 years. Why 5 years? Loan tenure was 5 years. Okay. Then EIR, then LAT. Prepare the LAT only for the first 2 years. Why? Because after 2 years modification was happening. So I prepaid whatever repayment was that I made. Acha, in this LAT till the date of modification, in the second year repayment, ideally I can also take 4,44,000 year instead of 2,44,000. Why? Because you are prepaying 2 lakhs extra, na? But that I will treat separately. Here I have only taken 2,44,000. This is done as per ICAI. Even if you take 4,44,000, it is fine. Na? It is not a mistake. Okay, both will work. But still, I will take only 2,44,000. The 2 lakh prepayment I will treat separately. Anyways, so this was the before modification accounting, simple. Then after modification, what do we do? Hello, mister, how do you do? What do we do? So after modification, what we do? Fine, follow the steps. Step number 1, carrying amount of old financial asset on date of modification. How do you get it? From the previous LAT. Second, present value of revised future cash flows. Revised future cash flows mean after you make the prepayment, refer the future cash flows. So after I make the prepayment, only 2 cash flows will be pending, these 2 cash flows. So I will find the present value of these. Okay. So just assume that the step number 1 is your old value. Step number 2 is your new value. Just assume this. Okay. So from old value, you have to come to the new value. So you have to reduce the financial asset by this much. Again, from old value, you have to come to the new value. So you have to reduce the financial asset. In the step number 3, you will pass a journal entry. How do you pass an entry? Because you have made a prepayment, you will say cash bank account debit. Okay. To financial asset. By how much amount? Whatever amount you wanted to reduce, you will record that amount in to financial asset. How will you adjust the difference? Normally the difference is adjusted in profit and loss, but because there is a relationship in the question, you will not adjust the difference from profit and loss. Instead, you will adjust the difference from the prepaid employee benefit expense. Why, sir? Because there was a relationship in the question. When there is a relationship, never ever adjust from profit and loss, always adjust from the prepaid employee benefit expense in case of employer-employee. Okay, so this is my step number 3. Because I made a prepayment, I passed the entry for prepayment also 2 lakhs. Then I adjusted the some amount with financial asset and then the balance with prepaid employee benefit expense. Acha, if there was no prepayment, then in that case you will just reduce the financial asset and you will adjust from prepaid employee benefit expense. Okay, I will refer that question as well. But because there was a prepayment, I took the prepayment effect in the modification part. Okay, as I was saying, I am not taking the prepayment here. I passed a separate entry for this year. Okay, so what is going to be the impact of this entry? The impact will be that the financial asset will be reduced. From this value, it will come down to this value. First thing. Also, the balance of your prepaid employee benefit expense will reduce. How come? See, it was this much on day 1. Modification happening after 2 years. So you will first write off 2 years prepaid employee benefit expense. This was the balance before any entry, before any modification. Now, you adjusted some amount with the prepaid employee benefit expense. So how much amount will remain? Only this much amount will remain. Why? This was there. You reduced some value of it, so only this much is there. Now you will write off only this much prepaid employee benefit expense. That also over how many years? Ideally remaining tenure is 3 years, but you will write off this over only 2 years. Why only 2 years? Because we reduce the tenure now by making 1 year principal prepayment, right? That is why. Okay, done, sir. So step number 4 is going to be LAT after modification. So just to summarize it again, how do we account for the modification? First, find the carrying amount of old financial asset. Second, find the present value of revised FCF. Okay, you will get both the values. Consider the upper one to be the old, the second one to be the new. You have to reduce this. Then pass the entry. You are making the prepayment, say cash bank account debit, to a loan amount, whatever you want to reduce, and balance figure will be transferred to prepaid employee benefit expense. Because of this, the values of FA and prepaid both will change. Now prepare the LAT for FA, and for the prepaid also I have given the working. Whatever you did, just have to pass the entries. Passing entries is simple. Just look at the workings and keep on passing the entries. Okay, so this was a very good question. Of course, just try to revise it very quickly, but do solve this and revise. Okay, then we have one more question, and that is going to be question number 7. Again, it is a question of modification. Let's refer the question as well once. Come. Yeah, here it is. Question number 7. What does it have to say? It says we lent. That means it is a financial asset for us. We lent 2 CR. No relationship, nothing is there. TC is there 10 lakhs on day 1. Okay. So in case of financial asset, do you remember TP plus TC is the fair value? In case of liability, we less it. In case of asset, we add it. Already revised, huh? Okay. Then not to charge an interest. Coupon was 0 in this case. Okay. And the repayment will happen after 2 years. We were supposed to take how much? 2.4 share we will take. EIR is given as 6.9%. Acha, change the date, huh? Yeah, 20th Feb is that, change it to 31st March. Okay. Now, after 1 year, there is a modification. And what is the modification? Previously, we were supposed to receive 2.4. Now, we will receive only 2.2. Okay. So, how to account for this modification? Simple. Again, divide the question into 2 parts. One part is going to be before modification accounting. So, you will say cash flows, fair value, because no relationship, no CFI, no level 1 input. You can assume the fair value. So, assume the fair value to be equal to TP, but there was TC also. So, add it. Okay. EIR is given, LAT you can prepare. LAT you prepared only for 1 year. Because after 1 year, there is some modification happening. Done till year. Then modification accounting you will do. How will you do the modification accounting? Follow the steps. First step, finding the carrying amount of old financial asset through the previous LAT. Second, present value of revised FCF at old EIR. The revised cash flow was reduced from 2.4 to 2.2. So take 2.2 cash flow and find the present value. You get this amount. Consider this to be the old amount and this one to be the new amount. That means you will come to know how much is the reduction going to be there. So reduction is of approximately 1869,019. Okay. Now pass entry in the third step. Here there is no prepayment unlike previous question. So you will not say any cash bank. In the previous question there was some prepayment which you are receiving. So we said cash bank. Here there is no prepayment. So directly pass the entry for reduction. So to reduce the financial asset, you will say to financial asset account debit, to financial account credit and debit what? Debit profit and loss. Sir, why profit and loss? Why not prepaid employee benefit expense? Here there is no relationship now. So directly profit and loss. And why not cash bank? No prepayment is happening. So directly reduce the financial asset and debit to profit and loss. Prepare the LAT after modification with the new opening value. That's it. Done and dusted with this question. Simple question was there. There is one more question there. And that is question number 19. Okay, we can solve that question as well. One sec. Yeah. Okay, what is in question number 19? It is again a very similar question where employer is giving a loan to the employee. So that part of the question proves to be the same, where employer is giving loan to the employee. Okay, at what rate the loan is given? 0% is the coupon. What is the EIR going to be, sir? EIR is going to be 5%. Okay, so EIR 5% is given. Okay. Then it is said that on 31st March 13, there was some modification. Modification we will see later on. Okay. So coupon 0, interest free loan of 5 lakhs. Coupon, EIR is 5%. Okay. How to solve this? Acha, let's discuss the modification also. So originally the loan was only of how many years? It was only of 3 years, right? But we extended term by a further 3 years. That means now the loan will end on 31st March 17. Okay. And the repayment was supposed to happen at 5 lakhs. Now it will happen only at 2 lakh 50 because there is some financial difficulty faced by the employee. Anyways, explain the accounting treatment on initial recognition and after giving the effect of modification. Okay, let's see how to give the effect. See, simple. Again, simple accounting first before modification accounting. Step number 1 cash flow. Step number 2 fair value. You will compute it because there's a relation. Step number 3 difference transferred to prepaid employee benefit expense. Step number 4 EI. Step number 5 LAT. LAT prepare only up to date of modification. Done, sir. Then modification accounting. How to do it? Step number 1 carrying amount of old financial asset. We already get from the old LAT. Then present value of revised FCF at old EIR. You are standing somewhere here on 31st March 13. It is said that the repayment will now happen on 31st March 17. That also only 2 lakh 50. So if you count from year till year, take the 4th year discounting factor for this. So you got the present value. Took this value. So this is the old value. This is the new value. You have to reduce the asset drastically because the repayment previously was 5 lakhs. Now it is only 2 lakh 50. So of course it will reduce. So this reduces the financial asset. Okay. Now how to pass the entry? Because there is a relationship involved here. Normally such reduction will be adjusted from prepaid employee benefit expense, but as per ICI in the solution they have adjusted from profit and loss. No reason given for this, but in exam if you remember what ICI have done, do this profit and loss adjustment only. I also discussed this, ICI done something like this. Okay, anyways, so there was no prepayment happening here again, so no cash bank is involved. Directly reduce the financial asset and debit to prepaid employee benefit expense and then prepare the LAT after modification. do remember, while passing the entry is not asked for the whole tenure. It is only asked for day 1 and the modification entry. So we passed it, done and dusted. Okay, so it is a very simple question again, only the part different being that we are adjusting the modification from profit and loss and not from prepaid employee benefit expense as per ICAI. Do remember that. Okay, done. Chalo. So this was the modification accounting in case of a lender as well. When you are through with this modification accounting now, so let me tell you one thing. We are done with this modification part. Okay, this is a very important part, because if a question comes from here, it can come from approximately 10 to 14 marks. The weightage can be so huge, and on the face of it, if you see, there are only 2-3 big questions. Illustration 124, illustration 123, only 2 big questions. Others, if you are able to solve 123, 124, others are a piece of cake for you. So 2 questions worth 14 marks can come. Okay, now the remaining points are there, small points. We will quickly revise all of them. Okay, now we will do this point, regular way purchase sale, and then post we will do all the remaining points, right? So what is the meaning of regular way purchase sale? Let's come on towards the notebook. Very small points are remaining, nothing major to be worried, right? Here it is. Yes. Now what is the meaning of regular way purchase sale? Just remember that whenever you purchase any shares from stock market, the delivery of shares in your demat account does not happen on the day you place the order. It takes T1 or T2 for settlement time, right? T1 means the day you place the trade plus 1 more day it will take to get created into a demat account, or T2 means the day you place the trade plus another 2 days it will take to create into a demat account. So now let's say, for example, you place the order on 1st April and it got settled on 3rd April. So this 1st April is known as the trade date. This 3rd April is known as the settlement date. The question arises is, on which date will you record the shares in your books of accounts? On which date will you record the financial asset in your books of account? Yeah. So on which date to record? That is the question in case of regular way purchase sale, right? So company can follow either of the days. If the company wants to follow traded accounting, it will record the financial asset on the trade date. If the company wants to follow settlement date accounting, it will record the financial asset on the 3rd April. So this can be chosen by the company, but of course whatever you choose, you will have to follow it consistently. Just remember that. Okay, then there was one question number 105, just a fairly simple question, you can just refer it. Okay, so this was regular way purchase sale, not very critical anything about it. Then the next point was impairment of financial asset. In case of financial asset, we have how many methods? ACM, FVT, OCI, R, FVT, OCI, and R, FVT, PL, right? In case of impairment, what is the meaning of impairment? Do you remember we also have one index for this, index 36? The index 36 impairment talks about impairment for PPE, investment property, intangibles. This impairment is specifically for financial instruments. Now how to calculate the impairment loss, I will discuss, but before that, do remember whenever impairment loss is there, it will be transferred to profit and loss. That is why the provisions of impairment are only applicable when your financial asset is measured at either ACM or FVT, OCI. Why? Because if you are following FVTPL from before only, in that case already each and every gain loss is already transferred to profit and loss. So if your financial asset is at FVTPL, no need to follow the impairment provisions. But if it is at ACM and FVT, OCI, you have to follow the impairment provisions. Anyways, then how to compute the impairment loss? So there are 2 methods. One is 12-month ECL, one is lifetime ECL. Which one to follow? If the financial asset is risky, for example, let's say I gave a loan to Ajay, but Ajay is making the repayment on time. So that financial asset for me, that loan given by me to Ajay is less risky for me. I will use 12-month ECL. But for example, let's say I gave a loan to Kishan. Kishan not making the repayment very frequently. He's defaulting on the repayments. Can I say for me that loan given is a riskier financial asset? So I will use lifetime ECL. So basically in 12-month ECL, we calculate the expectation of loss in the next 12 months. In lifetime ECL, we calculate the expectation of loss over the full life of the asset. But this is complicated in real life. But from exam point of view, calculation of impairment loss is fairly simple. Why? Amount of financial asset will be given, probability for loss will be given. Just multiply the amount by probability, you will get the impairment loss amount. As simple as that. Okay. So this was one discussion of impairment loss. There is one more discussion in impairment, that is loss bifurcation in case of financial asset measured at FVT, OCI. Let's say for example, you have a financial asset at FVT, OCI. What is the meaning of FVT, OCI? That means each and every fair value gain loss, if it is unrealized, it will be transferred to OCI. Now let's suppose your carrying amount was 100, fair value was 90. So you will reduce the financial asset by 10 rupees. Now normally this 10 rupees goes in OCI, but some information was given that out of this 10 rupees, the decrease of rupees 3 was because of impairment loss, the remaining 7 because of fair value loss. So whatever is the decrease because of impairment loss, you will transfer to profit and loss, and whatever the decrease is because of fair value loss, you will transfer to OCI. Do remember that part. Okay, simple. Then we have certain questions on impairment as well. Those are fairly straightforward questions, to be very honest, but still I will just help you go through with the same. One sec. Here it is. Illustration number 50. Let's say, for example, this is a question of impairment. See, what does it have? We have the value of financial asset, we have the probability of default, and also one loss given default is given. Just multiply this 1 million by 0.5% by 25%, you will get the amount of impairment loss. As simple as that. Acha, here also you have been given various financial asset information, how to calculate the impairment loss. Here loss rate was asked. I'll tell you how to calculate the loss rate. Whatever impairment loss is there, it is already given, present value of observed loss. Divide the loss amount by the total carrying amount. Let's say, for example, I did the working in my notebook, in my notes. You can refer this. I will upload this on Telegram. How to do it? I have the loss amount. Okay. And I also have the, let's say, for example, the loss on group X was 600. What was the total carrying amount? 2 lakhs. So how to calculate the loss rate? Loss amount divided by total carrying amount. You will get the loss rate. Loss amount divided by total carrying amount. You will get the loss rate. This is how you calculate. Okay. And there was one question which was of MTP, RTP. That was also very simple question. In that, do you remember I taught you just how to calculate the particular bifurcation of loss? If you have a certain loss, but information is given that some loss is because of impairment, some loss was because of fair value loss, the impairment loss will get transferred to profit and loss, the fair value loss get transferred to OCI. Here it is given. There is a loss, there is a decrease by 50. So this much transferred to impairment loss, this much transferred to fair value loss. Okay. But in this question, there are multiple things as well. I'll discuss everything. First, we purchase the asset. So we record the entry for purchase. See, we recorded the entry for purchase. Then we book the fair value gain loss and impairment loss, everything. Then the carrying amount became 950. In this question, later on, we sold the asset for 950 itself. That means we are selling the asset at carrying amount only. Sale price, carrying amount same, no profit loss. But once you sell the asset, because you booked the fair value loss in OCI R means reclassifiable. Whatever loss you booked in OCI, you will have to reclassify to profit and loss because the financial asset is out of your books. So this is the important entry which you will forget. Do remember that part. This was impairment. This was impairment. That part is over. Now the next point is derivatives. What is the meaning of derivatives? Do remember, derivatives we are only discussing in financial instrument from FR point of view. No discussion is done from AFM point of view. Okay, do remember that part. Okay, derivatives means any contract which value depends on an underlying. On initial date there is no or very little investment and the settlement will happen in future. This is a derivative contract, and each and every derivative contract will be measured through FVTPL. Okay, directly focus on the questions here. We have one question that is illustration number 118 of my book as of now. Yeah. Yes. See, it is fairly simple. What to do? Whenever the information for derivative is given, you have to measure the same through FVTPL, right? So for example, let's say we entered into a purchase contract of USD 20,000 at rupees 68 per dollar. Okay. Now, this is our derivative contract. Now the position are given as on first quarter. Settlement will happen after 1 year, huh? But the position is given as on first quarter. We are in a loss of 25,000. So whenever there is a loss, the position is unfavorable for you. So book a derivative financial liability, right? And transfer the loss to profit and loss because we are measuring at FVTPL. On day 1, there will be no entry. On first quarter, we measured the loss. Acha. The position as at 30th June is given 15,000 negative. As at 30th June means does not mean that you have to book another 15,000. Remember I told you this is the as on position. So your loss from 25,000 it has reduced to 15,000. So you will reverse 10,000 ka loss. So reverse it. Okay. Then on the 30th September your position is positive 12,000. Right. So now DFL is over. DFA is there. So whatever DFL is there, reverse it. DFA book it, transfer to profit and loss. Right. And then the ultimate settlement. The ultimate spot rate is 66. Now, whatever is the spot rate, you promised to buy at 68 rupees. You are buying at 68 rupees, but the selling price in the market, but the price in the market is 66. Can I say it is an unfavorable contract for you overall? Why? Because you are going to buy at 68 something which is worth only 66 today. right? So the gross settlement will be done. We will buy at the promised rate, we will sell at the market rate, because we are only buying for speculation, so we will have to immediately sell it. Whatever DFA DFL is there, just reverse it and transfer the difference to profit and loss. Simple. This was a derivative question, which is very fairly simple. Just focus on that. Okay, then we have one more question, illustration 120. In this, it is exactly same like 118. This question is exactly same like 118, but the only difference is there is a point written of return put option. Now what is the meaning of return put option? So for that you need to know what is call option, what is put option, right? So if I want to discuss about return put option, so put means right to sell, holder has the right to sell, so writer has the obligation to buy. So when I say return put option, just refer this column. Return put option, writer of the put option. What does writer of the put option has? He has obligation to buy. That means when they say instead of directly purchase, they might write return put option. So this also directly means purchase only, obligation to purchase. If it is a purchase contract, everything else is very much similar to illustration number 118. So focus only on this part in this question. Done. So this was derivative part done and dusted. Now we will move on towards the embedded derivatives. Now what is the meaning of embedded derivatives? Embedded derivatives is a contract where in the host contract there is also an element of derivatives. Now how will the element of derivatives be involved? Let's say for example there is an Indian company, we are transacting with US company. My currency is rupees, his currency is dollars, but the transaction is taking place in a third currency, that is yen, right? So I want to buy guns, but I am making the payment in a third currency. This is known as embedded derivative. When the third currency is involved, we will say that the host contract and the derivative contract are not closely related, and in that case the accounting for host will be done separately and accounting for this derivative part will be done separately. Again I'll repeat, because we are settling in a third currency which is neither my currency neither his currency, right? So there is a derivative portion involved, and whenever you are using a third currency, the host contract is accounted separately, derivative contract is accounted separately. I've made you write this as well. Host contract, derivative contract. First ask yourself whether they are closely related. If the answer is no, when will the answer be no? When third currency is involved. So in that case, do separate accounting of host and derivative. But if the answer is yes, if they were closely related, when will this happen? Let's say for example, you are buying guns, making the payment in dollars. So if you are making the payment either in his currency or in his currency, in that case, we will say the main contract and the payment part is closely related. No need to do separate accounting. Okay. So if they are closely related, no need to do separate accounting. Do remember that part. Done. Then we had some illustration number 100. It is a pretty straightforward question. I'll teach you how to do the accounting. Host contract year is always recorded at the day one's forward rate. Okay. So host contract in illustration number 100 was to buy solar panels. Okay. So you will not record on day one. You will record the solar panel on delivery date, but at what rate? On day one's forward rate. This is the rule. Do remember that. Done. Then treat the derivative part separately. Ideally in this question, there was one Indian company and one Dubai company. Chalo, I'll take you to that question only. One sec. Okay, here it is. Illustration number 100. So there is an Indian company, there is a company of UAE. Currency of Indian is rupees, currency of UAE is dirhams. But settlement is happening in dollars. Third currency involved. So we will say they are not closely related. Do separate accounting. Okay. How to do separate accounting? Buying solar panels, you will record on the delivery day, but at forward rate. Okay. We will record it. Derivative contract. Now you are making the payment in dollars. Just imagine. Do I need to buy dollars or sell dollars? See, because you are buying solar panels, you will have to make the payment in dollars. But you are an Indian company. You don't have dollars. So you'll have to first buy dollars. So a hint is whatever you do in host contract, the same thing you will do in derivative contract. First thing. So buy dollars. Next. Did we fix any rate to buy dollars? The answer is no. If we wanted, we could have hedged our position and fixed a rate on day one. And if we wanted to fix a rate on day one, you could have fixed the buying price of $65. You know that after 6 months you will need to buy dollars. If you wanted, you could have fixed the buying rate at 65, but you did not. Okay, you did not. Nowhere it is mentioned that we fix the buying rate. At whenever you want to fix a rate, you will always fix at forward rate, day one's forward rate. So if we wanted to lock the price, buy price, we could have locked at 65, but we did not do it. Now keep on checking the position. Okay, so in the derivative accounting, day one there will be no entry. What about on the maturity date? On the maturity date, just ask yourself one question. if you wanted to fix a buy price, you could have fixed at 65. Did you fix it? No. Now you have to buy at 66. Profit or loss? Favorable or unfavorable? Of course unfavorable na. You did not fix the buy price 65. Now you have to buy at 66. Unfavorable for you. So derivative financial liability. Okay. So in this question, in the derivative part, there is a loss, book it. Okay. So here there is some routing done. The host contract, we booked a payable. For the derivative liability also, because we lose, we have to make a payment again. So the derivative financial liability, whatever is there, you book a payable for it. Then both the payables, you will make the payment together. Okay, that's it. This was embedded derivative illustration number 100. We have one more illustration, that is illustration number 119. That also we will discuss. One sec. That is a fairly good question. Please see here. So let's say entity A and entity B enter into a derivative contract. Here we are going to sell equipment. Entity A is an Indian company, B is an Indian company. Both the company's currency is rupees, still transacting in USD. So a third currency is involved, right? Third currency does not mean a third currency. It means that it is neither his currency nor his currency. So a third currency is involved, right? So in this case, we are selling equipment. So host contract and the derivative contract will be done. Because currency is different, they are not closely related. Account for it separately. Okay, so host contract is to sell equipment. When to record it? After 6 months. And at what value to record it? At day one's forward rate. So day one's forward rate is 55. It is given. Day one's forward rate. Okay, so we recorded 55. Okay. Now what about derivative contract? Whatever you do in host, do the same in derivative. If you are selling it in host, you will sell it in derivative market also. But if we want, we know that we are going to receive dollars, we will sell it after 6 months. If we wanted, we could have fixed the sale price at the forward rate, that is 55 itself. Did we fix it? The answer is no. Now check your position. Here on day one, no accounting. Here there is year end also. Information on 31st March is also given. So compare a position 31st March also. How to compare? So if you wanted, you could have fixed the selling price at 55. You did not fix it. Now two rates are given for 31st March. One is 31st March spot rate and one is 3-month forward rate for 31st March. Do remember, you are comparing 55. What is 55? It is the expected rate of 30th June. So compare the forward rate with forward rate only, right? So if this is 30th June's expected rate, compare it with this only, forward rate of 30th June, right? So you will compare 55 with 45. So now imagine, if you wanted to fix the sale price, you could have fixed at 55. You did not fix it. Price went down to 45, right? Now you will have to sell at 45 because you did not fix the price of 55. Now you will sell at 45. So favorable or unfavorable? Of course unfavorable, because you did not fix at 55. Now you will have to sell at 45. Unfavorable for you. So recorded derivative financial liability. Okay. But this was only checking the position on 31st March. Ultimate date is 30th June. On 30th June, the rate turned out to be 60. Acha, don't say, sir, how are we comparing now forward with spot? Arey Baba, this forward is of 30th June. We can compare 30th June's rate with 30th June spot rate now. So now rate turned out to be 60. Now imagine, if you wanted, you could have fixed the selling price at 55. You did not fix it. Now you will sell at 60. You will sell at a higher price. Favorable for you. So reverse whatever DFL was there, book a DFA and transfer to profit and loss. So in net, DFA remains. Transfer the DFA to receivable and record both the receivables. From equipment also you will receive the money, and from derivative also you will receive the money. Done and dusted. There is also one more illustration of my book, illustration 102. You can try that in homework. It is fairly simple. If you are through with 100 number illustration and 119 illustration, this is going to be very simple for you. Just give it a try. Okay. So how to differentiate between a derivative question and an embedded derivative question? This is FR with the exclusive. You will not find this anywhere, only in AK sir's notes. Okay. So how to differentiate? How will we come to know that if a question is only of derivatives or it is of embedded derivatives? In derivative, there is no host contract. There is no buying solar panels. There is no selling equipments. There is directly purchase sale of currency. In embedded derivatives, there is host contract and also there is third currency involved. Simple. Okay. Then we will come on towards the next concept, that is hedge accounting. Question number 6 I will revise later on. I will come on towards hedge accounting now. Now what is the meaning of hedge accounting? Hedge simply means to mitigate the risk. When you want to reduce the risk, you will hedge account. In hedge accounting, there are various cases, but from exam point of view, we only have a question on cash flow hedge. So I will discuss only cash flow hedge here. What is the meaning of cash flow hedge? Let's say, for example, I am going to sell my classes to Ashish. He is from Dubai, but he will make the payment after 6 months. That means I am going to receive dirhams. that is Dubai's currency after 6 months. Okay, but my issue is I feel that the value of dirhams will depreciate. I feel that the value of dirhams will depreciate. Okay, so now how will I do hedging in this? Whenever you are going to receive money in future, and if you are hedging that future inflow of money, that is known as cash flow hedge. In future, I am going to receive money from Ashish. Okay, but I feel that the currency will depreciate of dirhams. So on day one itself, I will fix the conversion rate. Let's say, for example, on day one, I fixed the rate that after 6 months, when I receive dirhams, I will convert at rupees 5 per dirham. I don't know the conversion rate, just taking a random example. Okay, so I fixed on day one that whenever I receive dirhams after 6 months, I can convert that at rupees 5 per dirhams. I fixed the rate on day one. This is hedging. See, in embedded derivative, we were not fixing the rate, right? In hedging, we fix the cash flow inflow of cash rate, right? So what is the meaning of cash flow hedge? Whenever you hedge your future incoming cash flows, that is known as cash flow hedge. Okay, acha, how the accounting is done here? Whatever hedging instrument you account, you will account through OCIR. Like in derivatives, we did FVTPL. So whatever gain loss was there, unrealized, we booked in profit and loss. Here, whatever gain loss is there, unrealized, you will book in OCI, R and R. R. Oh yeah. Chalo. So there is only one question on this. Just focus on this question. Question number 14. Let's do it. Let's do it. Come. Here it is. Question number 14. So, acha, don't try to link this with embedded derivatives. Linkage I will do. First, as of now, focus only on hedge accounting. Okay. So here, what was the question is, we were going to sell some inventory of copper. Okay. For USD 100. Delivery is happening after 6 months on 30th September. We decided on 1st April that on 30th September we will deliver some copper for USD 100. Now this is my inflow which I will receive on selling. I fixed the rate on day one. I hedged my position at 76 per dollar. Okay. This question is saying we did cash flow hedge accounting. Okay. Now, so we fixed the rate at 76 per USD. That means whatever the rate turns out to be, after 6 months when I receive dollars, I can convert them at rupees 76 per USD. Okay. Now, on 30th September, what is the spot rate? 72. It is given. Spot rate on to be 72. But it doesn't matter to me. I will still convert at rupees 76 only. Okay. Now, further information is given of some prices. First of all, a yield is given of 6%. What to do with this, I will tell you. Don't worry. Then, some rates are also given. On 1st April, future price is given for 30th September. That means 1st April's 6-month forward rate is given 76. Then 30th June's 3-month forward rate is given 74. And 30th September spot rate is given 71. Now the question has one issue that there are two spot rates, 72 and 71. What to do, sir? So ideally in hedge accounting, bifurcate the full contract into two parts. One is the host contract and one is the hedge contract. For host contract, we will use the spot rate of 72. And for the hedge contract, we will use a spot rate of 71. Ideally, this is a mismatch. In real life, this can happen. There can be two spot rates. But from an exam point of view, this should not be the case because then the answer won't tally. Right? But it is given. So what ICI does is for the host contract, they will use a spot rate of 72. And for the hedge accounting, they will use a spot rate of 71. What am I exactly saying? You will understand once I do the question now. See, in cash flow hedge also, just like embedded derivatives, divide into two parts. One is the host contract, one is the hedge contract. For the host contract, what to do? In host contract, you are selling inventory. So here you will record the host on delivery day, but at what rate? At delivery day spot rate. In embedded, we did something different. That is why I'm saying don't link with embedded derivatives. Here we will record the host contract at delivery day spot rate. But we had two spot rates, sir. So for host contract, use the spot rate of 72. So on day one, no entry. On the delivery day, you will record bank/trade receivables to sale of inventory or revenue, whatever you call it, 7200. Okay, spot rate. Now, what about the hedge instrument? Just remember, whatever you are doing in host, you will also do the same in hedge. So in host, you are selling inventory. In hedge also, you will sell the dollars. Okay, because we are going to receive dollars. Okay. Have we fixed the rate? Yes. We have fixed the rate. Hedging done. That is what is cash flow hedge. We have fixed the rate at 76. Whenever we receive dollars, we will sell at 76 only. Anyways. Now, hedge accounting, hedge contract accounting. On day one, no entry. Let's check our position on 30th June. Now just see. I have fixed the selling rate at 76. The rate in market is 74. Favorable for me or unfavorable for me? Just imagine. I am going to sell at 76, but others are only going to be able to sell at 74. Can I say favorable for me? So 2 rupees profit. So we will book, just like we booked a derivative financial asset, you can book a derivative financial asset for hedge contract also. Okay, 200. But in this question, yield was given. So whatever gain is happening, this can only be realized on 30th September. That means you are booking the gain 3 months early. So book at present value, right? So we took 6% per annum. So 1.5% per quarter, book at present value, 197. Ideally, we don't use yield in case where the contract life is less than 1 year, but it is given, so we used it. Okay, so we book at present value. Okay, now let's check on 30th September, the ultimate expiry date. One more thing. Because this is hedge accounting, don't transfer to profit and loss, transfer to OCIR, because hedge contracts are accounted using OCIR. Next thing. On 30th September, what happened? We fixed the contract at 76. The rate turned out to be 71. Doesn't matter. We will still sell at 76. So we are going to sell at 76, whereas other participants in the market will only be able to sell at 71. Tell me, favorable for us or unfavorable for us? Still favorable for us, right? So rupees 5 favorable for us because we will sell at 76. Otherwise, the rate in market is only 71. So 500 is the again, but don't book full 500. Out of 500, 197 asset is already booked. So you will only book the incremental gain. That's it. So that means this hedging proved to be successful for you. So receive the excess money from the hedge, and also do one thing when the contract expires, because whatever you booked in OCIR, don't forget to reclassify it to profit and loss at the end. That's it. Clear with this? Yes. Chalo. So this was hedge accounting. Now, one exclusive thing I will teach you. Most of the students will face issue in bifurcation between embedded derivative and hedge accounting, and how to identify whether question is of hedge or of embedded derivatives. So I have prepared a good summary for you. Again, exclusive from FR with AK. Sir, see, in embedded derivatives, the contract is not hedged, right? And there is a third currency involved, right? That means the currency is neither of the buyer, neither of the seller. A third currency is involved. In hedge accounting, first of all, host is hedged. Second, there is no third currency here. If I am selling to US company, we are dealing in dollars only. Okay, so third currency not there. Either dealing in the currency of buyer or in the seller. So no third currency is there. So bifurcation, you got it. How to identify the question? Okay. Now, accounting can also create confusion because in embedded we are recording at forward rate. In hedge we are recording at a spot rate. So I gave a summary also. In embedded, on day one, for the host contract, you use day one's forward rate. You do the accounting at the end only, but at what rate? At day one's forward rate. For derivative part, just remember in embedded derivatives, we do not hedge our risk. We do not lock the price. Second thing, whatever remeasurement is done, transfer to profit and loss. In hedge accounting, on day one, on delivery date for host contract, we use spot rate. So we will record at delivery days spot rate on the date of delivery. For hedge contract, do remember price is locked. Whatever you remeasure, you will transfer it to OCIR. And on settlement, don't forget to reclassify the balance of OCIR to profit and loss. This is the difference of embedded and cash flow hedge. Do remember, this is not, you will not find this anywhere, but this is only for your use so that you don't get confused by things. Okay. Now the next concept is financial guarantee. Now what is the meaning of financial guarantee? Just see, for example, Ajay went to Dena Bank for taking a loan. Okay. The tenure of loan he asked for 5 years, loan value was 10 CR. Bank charged him 18%. But as soon as Ajay gave my guarantee, so I came in rescue for Ajay. I told the bank that I am giving guarantee for Ajay's loan. So bank was like, oh my god, Aakash Kandoi is giving guarantee. So let's reduce the rate. So bank, instead of charging 18%, now it will charge only 12%. That means because of my guarantee, can I say the rate of interest was reduced for Ajay? So we have to do this accounting of financial guarantee. Now the guarantees accounting will be done in whose book? It will done in AK's book, the one who is giving the guarantee. And do remember, for AK, it is a liability kind of a thing, because if Ajay does not pay, can I say AK has to pay? So for AK, it is a liability kind of a thing, right? So financial guarantee will be done accounting in the books of AK. How to account for this? On day one, financial guarantee will be booked at fair value. Sir, what is fair value? Because of my guarantee, can I say Ajay was able to save 6% interest? So for 5 years, so take the savings in interest for 5 years and discount the same, book it at present value. For taking at present value, which EIR to use? Use we have two rates, 18% and 12%. Take the 18% rate, that is rate without guarantee, because that is the rate actually in the market. So bring the present value of benefits, that is present value of interest savings. At 18%, you will get the fair value of financial guarantee. Okay, if there is no relationship between me and Ajay, between the one who is giving the guarantee and the one who is accepting the guarantee, if there is no relationship, you will book the financial guarantee and transfer to profit and loss. Okay, and of course I will not give the guarantee for free. I might charge some commission, so book the commission income as well in my books. Okay, but in above case, let's assume AK was the parent, Ajay was the subsidiary, and parent is giving guarantee on behalf of subsidiary. In that case, on day one, whatever financial guarantee you book, you will not transfer to PNL. You will book it as an investment in subsidiary, because relationship is there. Of course, sir, why it is credited financial guarantee, liability kind of a thing? Na, that is why. Also, when there is a relationship involved, commission won't be involved. Okay, so on day one, how to account? If relationship is there, investment to FG. Relationship not there, PNL to FG. Simple. Okay. Then, what about subsequent measurement? In case you remember, for financial guarantee, in subsequent measurement, you have to find two amounts. Higher of. First amount, amortized amount of financial guarantee. That is, just prepare a LAT for financial guarantee. Or, principal amount into probability of default. Okay, principal amount you will have in the question. This default probability will be given in the question. Use this and find the values. You will get two values, one this and one this. Whichever is higher, we have to keep it at that value. Okay, for this we will discuss in the question also. Just remember, for example, let's say this value turns out to be higher, so my financial guarantee on year end will stay at this value only. Now, don't book more guarantee of this value. It means that your guarantee was worth 1.87 CR. Now on year end it should be at 1.61 CR. So from 1.87 you have to come to 1.61. So reduce the guarantee value on year end. Okay, so you will pass an entry financial guarantee to PNL. Sir, always to PNL? The answer is yes. Subsequent measurement difference will always be transferred to PNL, irrespective of any relationship being there or not. To discuss this in more detail, let's do one question now, and that is illustration number 127 of my book. This one. Yes. See. Read very carefully now, because this is the question where you will learn financial guarantee very perfectly. So, son gives guarantee of 10 lakhs for subsidiaries loan. So, parent subsidiary relationship is there. So, we will book the guarantee through investment in subsidiary. Okay. The interest rate without guarantee was 8%, with guarantee was 11%. How do we do it? So, interest without guarantee 1 lakh 10, with guarantee 80. Savings is 30, bring at present value. For bringing at present value, use the discount, use the rate of without guarantee. Okay, we got this. Because relationship is involved, we will book investment in subsidiary to financial guarantee. First point. Now, how to do the year end accounting? Just find two values on year end. One, amortized amount of financial guarantee. How to find it? Prepare a LAT. No? Take opening, take interest, less repayment. What is the repayment? The savings of each year. You will get closing. Acha, do remember this LAT is notional. Huh? Don't think that why are we booking interest, why are we making repayment. In reality, no interest is booked, no repayment is made. This is only notional, just to find the amount. So we got the amount as 51,375. Then second amount we want is principal amount into probability of default. Principal amount is 10 lakhs. Probability of default for first year is 1%. It is given. Right, so we took 1%. We got the amount as 10,000. We will take whichever is higher. Sir, why higher? Conservatism. Liability, the higher, the more conservative it is. So we took whichever is higher, 51,375. Now from 73311, we want to go up to 51,375. So like a hucha, don't book the full value. From this value, you have to come down to this value. So reduce it. Reduce it by how much? You get 21,936. Similarly, you will do for the second year as well. Okay. This was the case of your financial guarantee. Your financial guarantee is over. Okay. Apart from this, there are two questions of my book, that is illustration number 101 of edition 7 I'm talking about, of illustration 101 and illustration number 16. These two questions just refer. These are direct questions, not based on any concept. We discussed them in class, but do refer them. Not LDR I can say, but do refer them at least once. Okay. If you want, I will show you which questions are those. One is, one sec. I will show you which are those questions. One is this one. This one. You will have 3 table kind of a thing. Okay. Just to revise this, in contract number 1, settlement happening on net basis covered under derivatives 109. Under contract number 2, you are buying the oil seeds for your own consumption. So ideally there is a concept of own use exemption. Just remember that part. Whenever you're buying anything for own use, it is not accounted under 109. So it is out of scope. In the third contract, again settlement happens on net. So it will be covered under derivatives 109. Just read it, you will understand everything. Okay. And there is also one question number 16, which you can refer. It is also a good question of MTP, RTP past exam. This is this question. Okay. Just refer it, you will understand. Very easy question. Okay. One more question is left to be revised, which I left in between. That was question number 6. Okay, let's come and revise that question. It is a very easy, fairly easy question. See what does it say? So we are basically in this question, we are buying 3 financial assets. Okay, one is option which we are buying, one is a debenture which we are buying, one is a shares which we are buying. Okay, we are asked the balance sheet extracts on year end. How to do the accounting? It is very simple. See, first you buy at 10,000, value on year end is 15,250. It is like a financial asset you are buying. When you are buying an option, it is like a derivative which you are buying. You bought a derivative for how much? For 10,000. The value went on to 15,250. How to do the accounting? See, I will show it to you. Wait. Here it is. See. So you bought at 10,000. You pass the entry. Then on year end, it went to 15,250. So there is an increase by 5250. Book the increase. Now, what will be the impact on financial statements? The option value has become total 15,250 on year end. This much has become, and in profit and loss, book the gain amount. This is the extract. Simple. Acha, for debenture we bought at 1,50,000. Okay, and EIR and coupon everything is given. So for financial asset we follow ACM method. We will prepare the LAT. So book the purchase price, then EIR, then whatever coupon is there you will repay. You will get the closing. So in balance sheet the closing value will appear, and in profit and loss the EIR interest will appear. Okay, now the main point was the third part. We purchased the shares. How many shares? We purchased 50,000 shares for 3.5, right? But the value went on to 3.75. Now the question is where to book the gain of 0.25. So basically in the last one of the question it is mentioned that we will use FVTPL only when it is unavoidable. In case of equity shares, company have an option to use an irrevocable option to value at FVT OCINR. Okay, in case you don't remember, go to business model test and CCFC test, you can find it there. So in case of shares, you have an irrevocable option to value the gain loss through FET OCI NR, right? Irrevocable option. So here we book the purchase first at 3.5, then whatever is the gain, if you are choosing FVTPL, you will book in PNL. If you are choosing FVT OCI, you will book in OCI. But what is done in this question is they have directly booked the gain in other equity. Why in other equity? Don't know. But ideally, either there can be two assumptions. If you are following FVTPL, you should book the gain in PNL. If you are following FVT OCI NR, irrevocable option, you will book the gain in OCI NR. But they are directly book the gain in other equity or equity, whatever is there. So we will, in case you remember what they have done, the same in exam. In case you don't remember, you can follow any of the assumptions. Anyways, so the shares will appear at 1,75,000 plus your gain value, that is 187,500 if I'm not wrong. Also, they did one more mistake. If they are showing in other equity, they should come somewhere in the extract. Na? If you are either following PNL OCI, so it should come either in the profit loss extract. If you are showing it directly in equity or other equity, it should come in equity. They have not shown that 12,500 anywhere. So even I have not taken it, but ideally you can show it. Okay. Anyways, so yeah. Apart from this, I guess everything else is done. So with this, can I say we are through with the complete revision of my favorite, everyone's favorite, financial instruments, right? Just remember one thing. In this revision, I have put in a lot of effort to revise each and every concept along with each and every important question. Even if you are able to tackle this much, it is more than sufficient for you. It is hardly, if you combine both the parts revision, hardly 3 hours approximately. In 3 hours, I have revised full financial instruments along with questions, that also in detail. Do remember, this is easy, worth 20 marks. Don't leave it. Only thing which is required from your side is 2 things. See, while listening to the revision lecture, there might be some concepts which you will recall. Good job. No need to read it again. There might be some concept which even after me revising, you won't recall. That is fine. Just mark that concept. When doing self-study, focus on that particular concept more. This is the first thing. Second thing, when you watch the revision lecture, whatever questions I discussed in this lecture, please do writing practice of those questions. Just referring won't solve the purpose. Do writing practice. That means the concepts which you were able to recall, good job, nothing to be done. The concept which you did not recall, revise it once by self, and then all the important questions write and practice. Remaining questions, if you want, if you have time, you can refer it once. Okay, so I hope this was helpful. I hope this proves to be helpful. Those who are watching it, please do leave a comment. If you have watched till here, do leave a comment. How did you like the session? And I hope you liked it. If you liked it, do hit the like button. Also, if you want the notes, you can find on the Telegram. I will upload the notes on Telegram. You can find it there. Okay, join the Telegram channel. It is going to be very relevant for the important updates. Till then, thank you so much. Also, if you are watching it on YouTube, if you want to buy the full English batch, it is available on bbvirtuals.com. Okay, so if you want to enroll, at least you can enroll. Acha, if you have enrolled or if you have availed the benefit, you can recommend it to your friends in case if you liked it. Only if you liked it, then only recommend it to your friends. Okay, so till then, thank you so much, everyone. Bye bye, everyone. Take care. See you all. Bye bye.